Okay, just started the recording. Today is Sunday, June 19th, 2022. And jumping right into it, this is a general webinar for the QTA members. And what we're looking at right here is the chart of the SPX. We just had 2 weeks of the market actually closing below 2 sigma. And the last time which we had that was during the crash of 2020. There's been a lot of talk about gamma exposure, and things like that in the chat. So we'll be covering that, I guess, will be the main talking point of this webinar, as well as answering any of the questions that you guys have. I try to leave my biases out of a lot of the discussions or a lot of the things in which I've posted. But if you guys caught any of the messages in which I posted on Friday in the notes section of the Discord, I kind of went over, yes, the bear market might not necessarily be over, but it's just time to start, I think, bringing into the conversation at what point do we think that it will possibly be over? Because if you are new to the market, there's one thing to take note of, that they say that the market is about 6 months ahead of the economy. That's something that took me a few years to learn, and it was always frustrating not understanding why would the market go up during horrible times. The last time the Feds were raising interest rates was back in 2018, and that was the time in which I was trading, and it was very frustrating during that time, not understanding why the market was going down at first and then why it was going up, and the impacts of that type of stuff you kind of learn later on in your career. Now, what we're dealing with right now, we have almost about the same amount of drawdown right here that we've had back here. Completely different time. As we know, this was a shock to the entire economy. This is a shock to the market. We don't necessarily have the same shock right here, as a lot of people were preparing for this kind of sell-off from all the way back here. So we're not getting the same crash, but we are getting, we can say, the same type of characteristics of a crash. The market generally would not do what it's doing right here with these massive gaps in this short a time frame. So this is what we would consider more so of a crash. Now, it does make sense for this to be happening after the consolidation which we've had now, because from compression, as they say, comes expansion. So when price does this, it usually ends up doing this. On top of that, that's kind of coupled with the fact that we are in a negative gamma environment. Now, if you're new to this and you haven't heard about what this is referring to, we'll be going over the white paper briefly on the topic. I first learned about GEX from Sqeeze metrics, and these guys published this back in 2020, and this was a very large eye opener for myself, and this was a large inspiration behind the building the QTA algo to begin with. So we will be talking about that. I use their site right here. This is just their homepage. If you just visit Sqeeze metrics, you can just come to the gamma exposure page, and this right here, if we were to hide the GEX is just short for gamma exposure. This would be the SPX right here. And if I was to turn this on, this is showing the gamma. So right now, the yellow orange line right here, as I hover, you guys will see over here, it's saying what the number is. It is currently negative. The market tends to consolidate when we are in positive gamma, or when, let's go to 6 months. And last, we'll say during this consolidation right here on the chart, this is the same price action in which we're seeing right there. Let's go back to the 2 months, and we will see that during this consolidation, you guys can see that the gamma exposure was positive. So as I hover, again, you see the number right here, it's positive. So right over this point, it's positive 8.8 billion. I'm just going to average and round some of these numbers because it'll be repetitive to repeating these huge numbers. But as you guys can see, positive, down here, negative, and now we are negative again. Now, to briefly explain a little bit of what that means, when price action is when one says that the market is in a negative gamma state, we're pretty much referring to it. You can think of it as a direct correlation with volatility. When gamma exposure is positive, you can think that the market is going to be a little bit more mean reverting, which means as the market is going to go up, it's probably going to come back down. As the market goes down, it's probably going to reverse pretty quickly and come back up, and then so forth and so forth. So that was the price action which we were having here during this positive gamma environment. The moment that goes negative, the market tends to be, the ranges starts to open up a little bit more, and we get a little bit more volatility. So the fact that we are experiencing a crash, coupled with the fact that the market's turned negative gamma the moment I believe we broke down right below here. Now, there's going to be a lot of GEX features that is coming to QTA. You guys will get a little bit of a preview today. Actually, this is not available yet for you guys. still developing on it. There will be a lot of features that will be added. I don't want to introduce too many new things until I think you guys have a firm grasp on everything that's already out there, as well as if I can put out enough videos to explain it. But still currently in the development process, and I will be going over how a lot of this can be used, as well as the fact that this will be able to be plotted on the charts. You can actually see the gamma exposures, you can see the open interest, the volume, and so forth. So we will be getting to that, as well as how you can use it to trade. But we do know that the market is in negative gamma state. Now, for now, before I get to that, let's just get back to the chart right here. If we know this after a large moves, if you guys, for any of you that follow the income-based trades, I will actually do a little bit of a brief introduction to the Discord, just because I believe some of you guys on this webinar right now are new, so want to break down a couple of the channels. But during this time phase here, this was one of the best 2 weeks for the income spreads trades. I mean, the returns here were astronomical. I usually aim for about 15% returns on some of these income-based trades. The guys that followed the trades during this time frame, we saw over 35 to 45 to even 55% returns on some of our iron flies. Now, we can use gamma exposure, we can use large moves and knowing when to take advantage of that, because it means you can kind of, just looking at technical TA, which is technical analysis, we generally know after a large move, the market will generally consolidate. So after a huge move happens, especially to the upside, it's not like necessarily to the downside. The market is more likely to put in a short covering, a rally, a sharp bounce. That's more likely to happen versus after the market makes a big move up. As you guys can see, if we just look back here, after a large rally, we tend to get a little bit more consolidation. Now, this consolidation will happen because gamma turns positive. So after a large move, we're more likely to consolidate versus when the market goes down, it generally bounces back up faster than when it goes up. So knowing that whenever we have a really large move, so some of you guys that are now practicing your calendars, your double calendars, your iron butterflies, your iron condors, anything that's non-directional or neutral, it becomes a blessing where most people are getting burnt out or getting chewed up by the choppy or having to scalp for small moves. These are the types of environments in which you want to put a little bit more risk on for your non-directional trades and kind of let them go to work and let theta just burn away at a lot of the options. The same, this is a great time right here. And then this was a great time right here, as well as during this time, it was a little bit shaky once we came back to the 200-day. The gray level is the 200-day moving average on my chart, and the orange is the 50-day. So after this rally here, it did get a little bit scary right here because it, you know, it kind of felt as if the bear market was already over. It was kind of a joke. We had this death cross, which occurred right here, which is when the 50-day moving average crosses below the 200-day moving average. And here it looked like, you know, everyone was wrong about the bear market. So it did get a little bit scary here, but it's always a little bit more comfortable to hold some of the non-directional trades, even when the market is going up a little bit more, because again, gamma is positive, the gamma exposure. So it's more than likely going to at least come back to a key level versus if you were to run something non-directional here, you guys can see how fast you can get blown out to the downside. Now, we are coming into some very critical key levels on the chart. I have locked off. This is a very high gamma level. It's also a key pivot level back from 2020. And then more importantly, this is the level most people are, the big topic of discussion is the 3,400 level. And that's just because it was the high before the pre-COVID crash right here. So it's something to keep in mind, and we'll be able to see that on the charts, on the open interest levels, on the gamma levels, and so forth. But now what happens is usually if everyone's aware of one particular level, we can almost expect it to get overshot. That's just the way the market works. Everyone's saying, oh, you know, the bottom is going to be in at 3,400. It means the market will probably have a flash crash below her, but it won't spend that much time below it. Again, this is just, you know, pure speculation and just assessing a chart very quickly, just looking at TA. Anything can happen. There's no one right now that cannot say with full confidence that the market won't come back down to these lows. No one particularly knows. If we were to think about things from a Fibonacci standpoint, and we looked for the full 50% retracement from the COVID lows, that puts us right around 3,500. We start to see a decent amount of confluences between these areas. So around here, it's going to start getting a little bit difficult for the markets to keep selling off. Doesn't mean it won't. On top of that, we have to keep in mind, again, what's different back here is we're having a little bit of quantitative tightening versus back here. This is quantitative. The Feds were coming in and helping provide liquidity to the market. And right now liquidity is being removed from the market. And that is the number one fear in the market. The number one fear has nothing to do with COVID. It has nothing to do with inflation and a lot of the other things that are kind of secondary to what fears the market. The number one thing to any marketplace that's going to be fearful to the participants is liquidity. If you were to go to the supermarket and you were a seller of goods, you were a trader of some sort, let's just say you're Trader Joe's, and your business, you supply apples to a supermarket, and you're concerned that there's not going to be enough buyers there of your apples, you start getting a little bit nervous. It's any commodity, anything. If there's not going to be people willing to buy and sell, if there's not going to be traders, it's going to cause a lot of people to stay out of the marketplace, and that's actually what's going to cause a lot of fear. During when we were having, if you didn't trade during this time, we had what was called limit downs. When the market, when the futures are down, I believe it's 7%, is the first halt in the markets. They will prevent any more selling from happening. They will actually close down the markets for about 15 minutes. We had, I think it was 2 or 3 of them around this time. I actually had COVID. I was in the hospital during this time here, so it was a terrible time for me, but missed out on a lot of what was going on exactly at the lows around this period, but was able to experience a couple of the halts that happened here. We have not had a limit down yet this year, and that goes to show the big difference between this time frame and now. Now, if we start getting limit downs, that's in a sense a sign that the selling is probably happening. Again, we'll be able to see a lot of this when we look at gamma in a second, gamma exposure, why that happens, and why there are certain levels that it's very unlikely that the market will stay below for too long. Even if we were looking at things on a smaller time frame, and we talk about just this past Friday, how earlier on Monday here, when we were considering a place to where the market would potentially go this week, the first thing I generally would do is, if it's a week following something that's significant, I will just jump back to QTA and go to the charts tab and kind of look at that year previous, the exact week in the previous year. And that's why you guys will see me occasionally will try to post something like, if I'm uncertain about what the market is likely to do, this is the first thing I do. I come and I take a look at the previous times in which I can find anything that's matched. So the previous quad witchings, how did the market trade? So starting off this week, I was not eager to buy because this was the last time in which we closed below. We had a gap down in which we've had like this. This was back in May, and the market continued to go lower. And I try to provide the links so you guys can click here and then check for yourself to see by Friday, because the links in which I posted was for the following day if you're trying to come up with some trade idea. But then jump to the Friday, and I like to just compare the whole week of what actually happened. So the last time we had a similar reaction, the market actually ended up Stefan, I'm actually just going to mute your mic because we can hear your coughing. So we'll mute you for a second. All right, so you're muted. Yeah, so I like to first and foremost just compare and try to find certain matches. So when we see this, it kind of builds some sort of structure in my mind to kind of have an idea for what's likely to happen. Only one instance did we have a very sharp rally after a gap down like this. So then I go in and inspect. This happened during 2020, so it makes sense. And then I will go look at the chart and see what happened before. I will come to usually if there's anytime there's a really big move, I will come to the candle stats and I will just try to see if I can find something that matches very similar. So let's just say we're looking at the SPY, and never like to go too far back just because the market was different. If you go too far back, your sample set is going to be a little bit obsolete, or it won't help you that much because the market has changed so much over the past couple of years. But then from here, again, we know we had this flash crash right here. That's the COVID crash. And these are the outliers. We had nowhere near as bad as what we've had here, but we don't know yet. These were the limit down days. The next step I'm going to check is if it's a Monday, we'll just type in Monday right here, and then I will just sort it and try to find if we've had any type of major gap downs. And then I will pull up that day. So we can just click this right here and it would actually pull us to that week, that Monday, and then jump to the Friday to see what ended up happening, just to get a frame of reference around what the market was capable of doing for that week. And it's really helped, at least for me, to be able to come up with the ideas for how I'm going to approach the week. As you guys know, I'm predominantly swing trading, and I'm thinking about where things are going to land by Friday. So on a week like this, the thought process from earlier on in the week was that the market it was the level in which I said I was completely confident with was 3,006. Well, it was the SPY, so it was 366, and on the ES, that's the equivalent of about this level. It was just because of understanding first and foremost gamma exposure, as well as how much premium there was in selling any puts below this level. The 366 strike earlier in the week, it had the most amount of open interest on Monday. And then on top of that, as the week progressed, the volume just kept increasing. Now, earlier in the week, all the strikes below this, they started writing more and more contracts lower and lower. Now, that ends up being a sign if you've observed this for a while and you take note of it, you'll start noticing that that's usually a good sign of, you can tell when assuming there's a ton of in the money puts that were sold, as we can see right here, because the market went way past where it should have gone. We've now sold off 2 sigmas in 2 weeks in a row, which is not something that statistically happens probably once, twice at most every 5 to 10 years or so. And we can see that what ends up happening is the open interest that did not exist early in the week, it starts to end up getting doubled and double as we go closer to Friday. So if you see this type of stuff starts coming up and there's more and more selling in that open interest, it ends up becoming almost statistically impossible. Nothing's 100%, but it's over 99% chance that all of these puts are going to expire out of the money. So being able to recoup some of your losses, let's just say you sold some of these puts, thinking the market was nowhere was going to close below 380, and you did this. Let's open it a little bit larger. So let's just say you sold these 380 puts and you did this 3 months ago because the market was all the way at 430, and more than a 2 standard deviation move or something like that puts the market at 380, and you sold this put, and now it's the week of options expiration on the quarterly, and you did not close out these puts while the markets did bounce when we were all the way up here, where it was a good opportunity to buy back those puts in which you sold. If you are a market maker, you don't necessarily always have the option to. So I'll get into that in a second. But as the market sells off like this, and we're now below key levels, you can, in a sense, start selling these puts, even if you're only collecting 10 cents, 20 cents, 30 cents. If you sell, 200,000 of something for 10 cents and you're collecting $10, that ends up adding up, and you're doing it across multiple strike prices. This stops at 330 because I only have it set to 150. I don't know how much more open interest there was above this, but that's one way that, yes, there are puts that are deep in the money to anyone that sold those options that are technically under the water. They're in the red on these positions. And we're not talking about the market makers yet, because the market makers are generally always going to be, they're not taking on the same directional risk as an institution, as a fund, or as any individual trader such as myself or you that are selling options. If you're on portfolio margin, you can sell naked options. So most retail traders, obviously, we won't sell naked options just because of the cost that it takes to do so. But if guys there's a couple guys even in QTA that are already on portfolio margin and can sell naked options, the maintenance requirement is nowhere near as much as what you would see. So for anyone that doesn't know, if you were to sell the 36 strike price on the SPY on the put, and you were selling it for 10 cents, you're going to get $10, but it's going to tell you the maintenance requirement on that is going to be 30. It's actually, to demonstrate that, it's good. And we'll jump over to option strat for a second, just so you guys can start seeing as I start talking about the dealers. The dealers are AKA the market makers. So let's go to long put. And let's say we were to actually sell that put right here, and we were to sell the 360 put. Your max loss is going to be the cost, obviously, of how much premium you're collecting minus the strike price in itself. So the strike price is 360. You're collecting $864 in credit, and then you just subtract the difference. Again, you don't need to do the math, but this ends up being your max loss, and this is going to be how much your broker, depending on the broker you use, this is going to tell you how much capital you need just to make this $800. Now, for a person that's just selling the naked options, they're more so just concerned with this, your break-even strike price. So if earlier in the week, as on Monday, the level that was mentioned was the 366, and then I believe, let's just find it right in the Discord itself. Anyway, I think a couple of you guys asked why the 366 level, and I'm just sharing this again with you guys so you can just see how it's a lot of the time as I'm developing as a trader is less and less just looking at the chart and just more and more thinking about what makes sense, as well as putting the pieces of the puzzle together as I start sizing up and having the conviction for bigger plays. Every trader is in a different path in their journey. Obviously, I'm at the point in which I'm looking for 5 to 10 trades that I can put a lot of size on and hold for a week, or at least 2 to 3 days. Now, this right here, there wasn't what was mentioned by this is if the market did get down below the premium, blah, blah, blah. So the 366, this is on Monday, statistically very low, using 366 because the 370 put for Friday was $4. So the similar situation in which we're talking about right here, this put right now, let's go for this Friday, and let's go something like 350. This put is currently going for $1.25. So if we take $1.25 and subtract it from this strike price, we will get this break-even price. So for anyone selling this put, which has a very high probable chance of expiring out the money, let's drag in the options chain for the SPY. And take a look at, this is for Friday. So the which one are we looking at? The 350 put. So the 350 put right now, statistically, if you were the type of person that uses deltas, so deltas is one measure of the probability of being out the money. Won't be talking about much of that in this webinar, but just bringing that to your attention right here. So this is pretty much saying this has a roughly a 15% chance of expiring in the money, which means it has an 85% chance of expiring out the money. So one person might come in here and say like, okay, there's a ton of open interest here. Let me sell a ton of these because it's going to expire out the money. If the market closes below 350, they're not going to lose any money. Their break even is actually this price right here. So the market will want to remain above three, if or not the market, but that person selling that, they're not concerned with if the market closes right here. As long as it closes above their break even, there's no real pain. Now there was so much evidence on the options chain that was showing it was almost like if you can start reading and taking a look at this towards the beginning of the week, you can in a sense see the sentiment, especially after a big gap down, because usually after a big gap down on a Monday, by Tuesday, you'll notice a ton of open interest tends to open up on the options chain for puts below a specific strike price, and you'll start seeing more and more that makes no sense. But yes, it's just $10. But again, if you sell $200,000 of those, that's a lot of money that you can benefit on, and you can feel very secure in knowing as long as the market doesn't completely break. And that's what would be referred to as a black swan event. Black swan event does not happen. I don't know the exact number over the past 100 years, over the past, we'll say 30 years, there's been a black swan, but this was a black swan. These limit downs were black swans right here. That's not supposed to happen. The market is already not supposed to close below a 2 sigma level on a Monday. It's not supposed to, after it's sold off already, and it's definitely not supposed to close 2 weeks in a row below 2 sigma levels. So this is I've seen a couple of you guys mention I forgot, it was a gray, it wasn't a Black Monday, a gray Monday. There was another term that I think one of you guys came across. If anyone knows, you guys can please refresh my memory. But that's what's expected for this year, where we're not having the same flash crashes. We're having a little bit of these slowdowns. But looking at the options chain here, getting some sort of frame of reference or some sort of idea, you guys already know there is the open interest script within QTA that you guys can just have this. You don't necessarily need to go to the options chain. So I just copy and paste this for myself and putting it on my chart whenever I share things like this, because if you're aware of where the open interest levels are, and let's just say you were to save it from a Monday, I will always have the weeklies, the monthlies on my chart for the following month, generate that script, put it on my chart, because this is fixed. So which means if it changes, I'll be able to see, hey, that strike price that was earlier in the week is no longer the open interest that has the highest amount of it isn't the strike price that has the highest amount of open interest. So I'll be like, something changed here. Then I'll go look at the options chain and see like, what did they necessarily do? Because if we were to generate this script right now for the 24th, the levels is going to plot on our charts again will be this one, this one, this one, and this one for puts, and as well as this one. So if the market sells all the way off here, and then I start seeing 50,000, 60,000, 100,000, that's when I start saying, oh, there's no way we're going any lower. And then again, unless of course we have a black swan event, but you can't build a trading career around saying or predicting black swan events, because you might be waiting once every 5 to 10 years for your one big trade. If you're just, if that's your business models, you just try to short one big black swan event. Obviously there's a ton of money to be made for timing getting puts correctly, which is the trade that some of you guys took with me here when we swung the puts from here to here. It was the identification that this was a very potential black swan, or at least some sort of over the weekend flash crash. That trade resulted in over 400 to 500% return from a close here to a close here. That's the only time in which I swing puts like that, is if I can identify this is very likely to happen. Otherwise, it's very uncomfortable to hold naked puts after we've already sold off, because puts get hurt a lot faster than calls do, because puts increase in premium as volatility increases, as we know. So do all options. But because puts have a negative delta, when the market bounces, that negative delta hurts the puts. And then on top of the fact that puts are long volatility, as volatility comes down, puts lose value significantly fast. And if you can talk to any traders back here that were in puts, there some great traders probably retired. I don't know if you guys know Umar. I met Umar back in 2018. I actually took his course back here. So he's pretty popular on Instagram. And as a trader, was down about $500,000 in puts right here because a lot of us were still expecting the market to at least do a double bottom. We didn't think it would have gotten stuck here, and a lot of people continued to hold their puts even though they were a little bit further out. It was the money kind of evaporated in 2 days, and there are professionals that their entire playbook is after a huge gap downs on a Monday, they will sell puts for 2 weeks out or that following Friday, because even if the market is going lower and you sell a put, all you need is one day of the market to go up, and those puts will lose 50% of their value. So if you short a put, you sell a put for $5 and that put goes in the money, and now that put is going for $20, you're down a lot. You're down over 300%. But all it takes is one green day in the market, and those puts will go from $20 to $2.50. So it's a ridiculous, in my opinion, right now, because the amount of risk that's taken on. But they have more of the engineer's mind, or the engineer's personality and mentality, will saying they just play the numbers and just stick to that business model of knowing one green day and they can close out for a 50% return, and that's what continues to happen. Now, going into a week like this, unless we get some sort of a flash crash, I would not even be considering or looking at puts. It's just, if you are, for me personally, it's just going to be a quick scalp. If you are able to trade futures, I would suggest you trade the futures if you're going to short versus trading puts, just because you don't have the same risk when it comes to scalping the futures. You won't be so nervous with one quick bounce. And as we go into this day here, so hopefully that if I made a little bit of sense with the thought process of logic, because I haven't actually ever explained that on a webinar as to how from earlier in the week I'm thinking about where would I feel safe being long. And because I have a little bit more of the contrarian mentality, it means if I know 366 is the level that the option sellers are their break evens from selling the 370 put, because 3,705 was the 2 sigma on the ES. 370 was a lot of high open interest. There was a lot of gamma at 370. If I know that there's a lot of people and participants in the market with the same thing, because you can't hide what's on the options chain. You can't hide the open interest in the volume. There's certain things that you can manipulate. You can have dark pool orders. You can have all that other stuff, but the options chain is the options chain. And reading that, it shows 370, it shows no one with large money wanted the markets below much further than 366, which means anything below 366, all I'm thinking about is should I just get long, should just looking for some sort of opportunity to buy, or you can just sell the puts, which is why the trade I took was here on this day. And then I believe on yeah, with you guys that asked on Thursday, one of you, I think his name is Sugar in the chat, that asked as soon as the market opened, when I said the 360, just getting an at the money 366 call, and just for a scout back up to VWAP, because you can't ignore the trend and you don't want to be holding your long trade. So if you're trading counter trend, which is already something that's not, if you're new to trading, it requires risk management more than anything, because even if you're trading counter trend, and let's just say you thought this was the bottom, and then you take this trade and then it comes down later and then you stop out, you're not taking much of a loss. And then the next day, let's just say you buy this here and then the market rallies and you get a nice win, but then, the market gaps down the next day and then you try to take this and then you get stopped out. As long as you can honor your stops and you know when to trade them, trading the contrarian way, which means trading, counter trend, it's not something that I would suggest unless you have really good risk management, because I have no problem taking, personally, I can take 10 trades in a day and lose on 7 of them. And it's not going to affect my psyche, because those 7 trades, I'm probably only losing 30 cents a contract or so. And then I know if I get my 3 trades right, I'm probably getting about $2 out of the contract. And those 3 times 2, that's $6 is a net reward. And out of those 30 cents with those 70 trades, it still ends up being less than $2, of a loss. I still end up with a net positive position of over 4, because I don't have the same issue that certain traders might have regarding holding. So you have to first identify your personality. If you're struggling right now, or you're trying to figure out what system or what style you want to trade, you can't necessarily trade a system or a style that's not going to work for you, because on a day when we gap down like this, I wake up pretty excited because I know I'm going to get a bounce trade that I'm going to be very, very confident in, even if it's just a small scalp such as this one, because that's the one trade in which I'm content with or taking for the day, as well as the previous days. This was the day here there on the resource tab. If you guys didn't catch the video, trying to recap certain opportunities, and there's a few more to to do that will probably be up by tomorrow. But here's the QTA intraday zone. It had confluence with a couple other things. First and foremost, the previous day's low. Whenever I see that the QTA intraday zone is kind of lining up with the key structure level, I get pretty excited. It doesn't really matter what the market is doing or whatever, because I'm just looking for, again, reversion to the mean trade. Now, before the day starts, I used to think about it as if it's the weather, and think about what type of temperature or weather environment we're going to get. Is it going to be a cloudy day? Is it going to be a sunny day? Is it going to be a rainy day? What type of day are you expecting? If this is Tuesday and this is the day before the FOMC, so this is Wednesday, and the market just made a huge drop, there's going to be a lot of, passive traders. There's going to be a lot of people that are waiting to see until the news comes out, which means this ends up being a day in which you won't expect it to be a trending day, because the market is either going to consolidate, it's either going to trend up, or it's either going to trend down. There's only three options here. If you can kind of narrow it down before the market begins, you know which playbook to take to whip out. And if you're expecting a choppy day, it means the playbook, if you trade spreads, is you can run at the money iron flies, you can run iron condors, 0-day trades or whatever you can run there. But if you're a scalper, it means you want to be trading reversion to the mean, which means, okay, here comes the 2-day anchor VWAP. Let me let me try to get some puts. Let me just scalp it back down to VWAP, and let me see if I can get a scalp back down to low of day. Target should always be low of day. That's the thought process in which you should be having. We come down to the intraday zone. Here's the previous. We see that we're buyers here from the previous day, low of day from the previous day, a little bit of buyers right here. If you're using other services, there's a lot of great tools out there. I love Bookmap for confirmation for some of you guys that are using it now. It's excellent to be able to see the liquidity on the chain. I read the tape. So if I'm scalping, I'm going to be looking at the tape, and I just need to see the confirmation of some large orders coming through, as well as some sort of confirmation of a wick. But if I'm already confirmed that, or I already feel confident that today is going to be a choppy day, I won't even wait for confirmation. The moment the level gets there, I have limit orders in on the options. The same way, as soon as the market opened on Wednesday, the strike price, I already know the 366 strike, I'm going to be getting it for $3.50. The trade, it opened at $4.70. I already have my limit order set for $3.50. So I'm not even paying attention to when it comes down there and gets filled. I have an alert. I will be in the trade because that's the price. I know I want it, and I know my stop loss is going to be $2.50. Going to give it $1 stop loss. If I only want to risk $300 in a trade, it means I can only get 3 contracts. That's my risk for that particular setup, and that's my trade, and that's the thought process. It's not necessarily looking and waiting to time it perfectly. I'd rather be wrong I'd rather just be wrong on the thought process that I thought was going to happen for the day, if I'm coming into the day thinking that way. And if that's something that you don't do, consider that approach. Try to limit it. Again, it's 3 options: choppy day, trending day, or a trending down day. We come down to here. You're in from here to here. The average returns right now, just as because of where the VIX is currently at, the average at the money 0-day option or 1 day till expiration option right now on the SPY is anywhere from $3.50 to $4. It's kind of in that price range right now. So you kind of already know. I don't need to, look to see how much I just know this just from looking at the chain for the past 3 to 4, like the past month. You can just kind of keep this in mind. So if you trade 2 contracts and you're risking $1, that's $200 in risk per scalp per trade. And the average return from a bounce back up to VWAP is about 20 to 23% or so in that range. So right here, opportunities like this is a scalp, this is a scalp, this is a scalp. If you use something like Bookmap, you will see the liquidity here. The liquidity tends to always end up being around these key levels, because QTA is not the only system or not the only type of thing out there that's calculating these types of levels. So there's going to be a ton of other algorithms that are able to, have the same levels. And then it's not actually a person that's sitting there with millions of dollars that's pushing buttons. There's a conglomerate of a bunch of machines and algorithms that are executing these things. And you will see liquidity get added and removed around VWAP. You will see it around the 2-day anchored VWAP. You will see it around this level, and you will see it around this level and all the other levels that are on your chart. So you already have the levels. And if the problem, most traders are going to fall into a category of poor risk management or poor execution or just poor identification of a good setup. So if you are struggling right now, because the market is extremely hard, by no means is this market right now very easy. This is by far one of the hardest markets I've traded in. And this first remedy and solution to that is sizing down. So if you guys see, I'm not trading I hadn't traded the SPX this entire week. That's the first way to make sure I don't do anything stupid or I trade emotion. I just went to the SPY. SPY is 10 times less the size of the SPX. Already feel inherently comfortable, which means I'll get an at the money option in the SPY. I'll get like 3 of these or 4 of these versus an at the money option in the SPX. If I get an at the money option in the SPX, I'm going to be holding my breath because I'm going to be so nervous because of the thought of, if I'm wrong, oh my God, I have 2 of those, it's instantly going to be down so much money that it's going to affect the thought process. So size down right now. If you used to trade in 10 contracts, go down to 5. You just want to make sure as the market is coming down, and what we're having right now, if you end up, if it's 6 months into the year, this is now the ending of Q2, and let's just say the market is down this much right now. If you are not even, if you are just break even on the year right now, that means you are outperforming the market, because there's a ton of people that are actually down significantly. People are blown accounts, people are down 50, 60%. People are down the same amount as the NASDAQ, the same amount as the SPY, 30%, 20%, and so forth of what they started the year with. If you're just, maintaining, that's already outperforming or doing well, because this won't continue. The market won't stay down like this forever. It might go on for another 6 months. It might go on for another 10 months. No one exactly knows. But at the same time, we do know there's a lot of traders out there that also know if the average return for the market for the past, the average bull market, if the average return for the year is about 10%. The last bull market in which we have, I believe the average return was 13%. Now that's above normal, right? So the average should be 10%. We just had a bull market of 10 years that lasted with an average return of about 13%. Again, don't quote me on the exact percentages. This is just me just from remembering stuff off the top of my head over the past few years, right? So the knowing this, the stats also shows after a 13% return in the markets, the next 10 years, the market tends to revert back to having an average return of just 10%. We're not going to have the same strength in the next 10 years that we've had in the previous 10 years out of looking at the past 100 years worth of data. And that's just the way that goes, which means we're going to get a little bit more of a passive. But as we know, the market is always in that, notorious bull trend. And as Warren Buffett, as a couple of the other, large guys have said, if shorting the S&P is essentially not believing in the American economy, essentially. And whether they believe that or not, at the end of the day, 100 years, the market has continued to go up. And there are people that are fully aware of this. Now, as we look at this chart, you want to think of the psychology behind all the other participants. If you are slightly flat right now, you are break even, or you are just slightly green, you're outperforming. Psychologically, you're feeling a lot better than people that are completely blown up and really burnt out. What ends up happening is the last bit of money, as we know, finally comes out of the market, and we get some sort of whatever type of drop. We get the capitulation drop or whatever that could presumably happen. That's exactly just when everyone is completely fatigued. That's when everyone's dropping off. Just when everyone is so over the market, they're tired of losing so much money. We know the type of opportunities that are generally presented with us. So you want to just keep your mind sharp and try to tell yourself, is it this area? Is it this area? Is it this area? Is it this area? Maybe it's all the way down here. Maybe it's a level. Maybe it's 200. We don't know, but at least start opening your mind for that. And then also be aware that if the average return is 10%, there are other institutions, there are funds. I posted in chat on Friday at SMB Capital. Mike Bellafore's founder from SMB Cap had mentioned when they did their monthly review that their highest earning trader at SMB Capital pulled in 90% of his profits on the bounce that occurred right here, because these returns that happen, these bear market rallies, these short coverings, whichever you want to call them, they are still, this was an 8% rally here. So from this exact low to this rally right here, or we just take the 2-day rally, this is about 6.5%, with the high being around 7%. From here to here, this was over 10%. From here to here, this is about roughly 6%. From here to here, 6%. From here to here, almost 10% at its highs, over 10%. And obviously from the legs down, this was one of the biggest legs down. So we had 12% in terms of a straight shot right here. So this next leg down was one of the most aggressive ones which we've had. It. The only time it was matched like that was back here. So this one was when this was when the shock really hit the system. But once the market got this out of the way, it woke everybody up, because now it wasn't going to expect that type of same drop. This was shocking, obviously, because of the CPI numbers. Now, when we start combining all of these things, the average return is 10% for the entire year. It means if you can get, if you would have caught at least 1 or 2 of these, the thought process being you've already outperformed the market 2 times. If you've caught 2 10% rallies this year, it's already a great return. Even if you taken, you tried to get it and you missed on, maybe this is only 2 months and we're 6 months into the year, so you only had 2 months. If you have a good risk management and you had 2 months and you caught those returns and you have a 10% return on your entire portfolio, but during the other 4 months, you kept it to a -2% loss, you're still net positive on the year just using this math actually is not even a completely 100% accurate. You should still be up at least 2% on your entire portfolio, but in actuality it's going to be 12% because we have to do 2 times 10. So you should still be up about 12% for the year, which means you've already halfway through the year, you've already performed, what the market usually does. For a fund, the term is called alpha. So the objective for any fund trying to raise capital is trying to perform alpha. Alpha is just 2 times what the market does. So if the S&P does 15% this year in terms of its growth, as a fund, you want to do 30% because that's going to attract a lot of investors and a lot of clients. So there's halfway through the year, there are funds that already have performed. They have already done 10 to 12% on the year. And now the objective is what can they do for the next six months? How can they perform alpha? And as an individual retail trader, I try to, just because you're trading with your own capital, in my opinion, it doesn't mean you can't consider yourself a money manager, a portfolio manager. You can't think of, you might only have an account of 5K, but it doesn't mean you can't think of it as if it was $5 million. And how would you manage $5 million? How would you trade? What type of risk would you put on the trade? The identification for yourself should be, is it very risky right now? It is very risky. And if you want some sort of way to measure that, we will be looking at GEX. GEX gamma exposure can be what you determine to be if the market is riskier right now. We are in a negative gamma environment. It means it's risky. It means size down. Volatility has increased. You don't want to lose as much money. If you get one good, let's just say the market did bounce from here to here. That's 15 points in the SPY. Let's just say that happens this week. We go back up to, this is a VPOC right now. We go back up to this VPOC. We have a little bit of the doji here. There's a little bit of selling. We're on this trend right here. Let's just say you go in on Tuesday because market's closed tomorrow. And you decide to just be long, and then you just get lucky. You just say, I'm gonna grab the 375 call because why not, right? It's the 375 call is going for 250. I'll put $1,000 on that trade. I'll get 5 of those, right? And the market does go to, call it 382 or so. That grand turns into 5K for this week. You end up saying like, oh wow, okay. And then the next week you tell yourself, okay, the market looks a little bit risky here. We're back negative gamma. Things are looking pretty crazy. Instead of getting 5 contracts, you drop it down to maybe you'll only get 2 contracts because this might be a red week for you because you don't really have a good edge. You don't really know what's going on, and if you take a loss, the loss should be smaller than the week in which you feel you have edge. I had felt tremendous edge here. I sized up large on my non-directional trades. I felt very happy back here. And then this trade right here has set most of us up for the entire week. I almost felt inclined to not even trade this whole week. And I would have been better served actually just not trading the rest of the week because of how much was made. It was for every $200 used on that swing, $1,000 was returned. And those are SPY puts that went from 65 cents all the way up to $4, and QQQ puts that went from $1.11 all the way up to $7. That's a monster trade. You size down after a big win like that. If there's anything I've learned from anybody that has a lot more experience than me, or the fund manager, has always told me whenever I have a good month, a good week, he's the one that will usually tell me after I'm realizing profits after a good move. He says, Brian, don't trade Thursday, Friday. You've already hit, a 2-week goal in 3 days this week because the amount of profits is coming here. He's the one that said, don't trade the next couple of days. But I'm a trader. It's hard to resist not trading. So yeah, I didn't take a big loss, but gave back a little bit of profit here, and it kind of sucks. So if I was up, 5-6K, came back and gave back 2K and didn't listen, and then, felt kind of bad, but then didn't do anything here, and then came here, saw the opportunity because my mind was clear, didn't have to do anything here. So you try to manage, not only your expectations for the market, but see if you can first feel as if you have some sort of edge identification prior to the market open. What type of day are you expecting? What type of trader are you? And if you only have one skill set in your playbook, which is just scalping, reversion to the mean, that's not always going to work, because when the market is trending, it means you're going to be trying to short as the market is going up, or as the market is going down, you're going to be trying to buy the dip because you think it's going to bounce. You have to first identify what kind of characteristics meet that criteria. And to help you guys with that, if I do come in and I do try to mention something, I'm going to mention if there's Momo. So this week, whenever there's some sort of potential Momo in the trade, that stood out to me was just NEO. So the scalp, and this is why scalping always bothers me personally, my gripe with it. Everyone's different. I scalped NEO. I had the perfect entry from here, and then I got out right here. That's what I caught from NEO. It was pretty great. Contracts, I think, went from 60 cents to I don't remember where. Can't remember. Small trade. Very upset because knowing this was textbook, break of a downtrend here. It gapped up over the 2-day anchored VWAP. It matched all my criteria for back in the days. The trades, I would have been all over this. This is where I would have gotten a call from friends that would push me because they know I trade small. Like, get 100 of these contracts right here. This is a monster win. It's a missed opportunity, but then the follow through that comes from a trade like this, being in the $17 calls, this thing goes 3 points in the money. Now there's no pain. This is, obviously posted. I'm glad a couple of you guys did catch this trade. Whoever DMs me and say, thanks for the call out and things like that. But this is, if I don't think a stock has this type of potential, chances are I'm not even really paying attention or looking to it. The same thing the previous week was Roku, as we mentioned in chat. Roku dropped 25%, and NEO being up from this entry. From here to here, this is 25%. So these are huge moves in which, because this is what I trade for. I don't mind waiting 2-3 days for this type of opportunity. If it doesn't come there's other plays in the playbook. But the problem is, if you're just stuck doing one thing and you haven't expanded your playbook, or you can't identify when it's time to switch things up, not only will there be a lot of missed opportunities, but you'll find yourself fighting not only the trend, but you'll find yourself kind of projecting what's wrong with something that's personally with your trading and thinking it's the market. There's a ton of people that were probably shorting, NEO all here, not identifying that this is not the type of move. It's not a reversion to the mean type of day. There was a catalyst. This is textbook 101 for momentum traders. There's a checklist back in the days. And some of the S&B Kappa videos are pretty good on this, but you can see like there's a slideshow. You should be able to give a presentation on why you decided to choose this ticket. What was the RVOL from pre-market? RVOL is just relative volume. Was there a catalyst? If there's a relative volume, if there's a catalyst, did it break trends? Did it gap over any crazy moving averages? Where's the anchored VWAP? You should have some sort of checklist for yourself that you decide on what criteria matches to make this stock have the potential for some sort of a move in which you think. Just like you can determine if the market is going to be pretty choppy for the day, you should have a playbook for what you think is going to be some sort of trending move up or a trending move down. These are things that you can work on, especially if the summer months or things are going to be a little bit slower, or presumably should be a little bit slower. It's a great time to, even if you're outside, you're on the beach, or you're enjoying, you're in the park or wherever, you can still be checking, not necessarily checking the market, but reviewing all things, even review previous trades in which you took. If you scalp this right here, when I journal this, as I'm for every, as soon as the market closes, another 4 or 5 hours in which I'm still in my office working, documenting and journaling everything, because it's just a desire to want to get better. And if you're looking to get better, you're looking to, trade professionally, or you're just looking to trade for yourself to actually get out of, your 9 to 5 or whatever job in which you have, it should have the same amount of time. As the market closes around here, to me, as far as I'm concerned, the middle of the day is time to start journaling, documenting, taking screenshots, sharing things, start saying, what could I have done better? What could I have done if I had a little bit better? And then going into the power hour session is then you start looking for another opportunity. But things like this, if you did not necessarily, now it's one thing if you just only trade the SPY, but if you were not able to catch even some sort of a piece of this is something that's worth going back and going on demand and then reviewing here, see what happened during pre-market, because this is a bear market and NEO was one of the only things that had a major rally, as well as Boeing. But I didn't really care about Boeing, so I didn't even bother to mention it to any of you guys. But Boeing was surprising this week, but I didn't call this out because, again, don't care about Boeing. So let's jump back to the SPY, and I can jump. I'll jump over to GEX now, so you guys can it's a gamma exposure. So let's actually close this out now, and hopefully starting the first measure, if you will. Is it risk on or risk off, right? And I mentioned, taking a look at this right here. If we were to take a look, and let's go to Max, and let's, for curiosity purposes, this is the crash of 2020. If we come right here, we can see that the gamma exposure right here at this point, it said it was, okay, so about -3 billion. We had down here, it was -4.2 billion. This was crazy right here. This was -5.6, and down here this was can't really pinpoint it there. It doesn't need to be the exact, just trying to give you guys a frame of reference, an idea. We're now -3.8, right? And You can download this right here. So you can download this and put this into a spreadsheet, and you can kind of play around with it for yourself and see. What's more than likely is what happened this past week, as we know, the elephant in the room was all of the option premium that happened. Let me see if I can find a screenshot here. So this was Friday. I took this screenshot right after the market closed, and I add this to my journal log. So this is the end of the day. This is the most imbalanced in which we've seen, but most of the puts were in the money, so deep in the money. So at the beginning of this webinar, as I mentioned, even though there's a lot of puts that were in the money, there's a way to still sell a ton more out of the money puts to recoup some of these losses if you're some sort of naked option seller. And I'll talk about now the way the approach the market makers are going to have with something like this. But this is insane for all intensive purposes. Let's close this out now. Let's close out this tab here, and let's take a look at again, you guys don't have this available yet, so don't worry, don't like click around trying to find it on the site. It's not live for you guys. I was not going to have this released until probably mid next month, but since you guys are talking, so many of you are talking about it, I'll probably try to get it released by next week, and at least the early version of this, because there's a lot more in which I'm intending or planning to add to this to make it a little bit more simple. Because at the end of the day, it doesn't matter how much tools or access to information you have. If you can't really understand or grasp the problem that you might have as a trader, it doesn't matter how much information you have. You're still not going to be successful if you don't understand risk management. If you can't identify the potential for what should likely happen for the day, or what type of playbook you should be using, it's difficult to understand another layer. Because the intent even behind the options page was to try to simplify some of this. When I first mentioned to some of you guys about the premium imbalances, I tried to keep the numbers pretty small and not show the notional values, because the notional values are in the billions behind the actual open interest and stuff, and was just trying to simplify it and just saying just take a look at where, first and foremost, understanding where's the most amount of liquidity on the options chain. So if we ignore Apple and let's go to the SPY, you want to first and foremost, the weeklies will always have a lot of interest, obviously, because that's where most day traders are participating. So we should come here and be the 24th and say like, okay, so we should already be aware of this. This is pretty, this is pretty decent. But then definitely have this marked off and say, okay, the 30th, there's a lot of premium here. How's the open interest? And okay, there's a lot of open interest here. Let's come down to here. There's a lot of open interest down here. Obviously, it makes sense. This is the monthly. This is the quarterly. You get a little bit familiar with this type of stuff. Now, if you're trying to reduce, and anything in which I put out, or even anything in which I try to say in the Discord, is not to bombard you guys or clutter you guys with a ton of information. I mentioned one level for the week. Game plan doesn't change for me. If I identify something from Monday and then it happens, it comes to fruition later in the week, it means I just waited for a few days to come in and decide to either scalp the trade, sell the puts, run a put credit spread, run some sort of butterfly, do something, right? For me, in this case, I bought a bunch of call diagonal spreads and different ones. This is the position in the queue. So we'll talk about my positions in a bit, but just how I might approach this is just start scaling into a ton of call options that have a decent amount of time around where I see there to be a ton of open interest on the chain, and just start positioning and managing risk and coming with the game plan. If we sell off to a certain level, I might use an open interest level, or I might use where there's a high gamma exposure to decide what I'm going to do. So if we come here, obviously everybody's trading style is different. You want to make sure you identify yours. So just understanding and studying and learning GEX for the most part is not going to make you a better trader. Putting learning risk management, learning your own mental state, understanding when to really know when to put more risk on, when to put more risk off. These are tools that's supposed to help you with making those decisions, but they're not going to make you suddenly become Michael Jordan of trading if you don't get a lot of the fundamentals and the basics under the way. And if we pull up, what we're looking at right here is the SPY, all right? And this is the net gamma exposure. So generally, whenever GEX is calculated, it's based on about 3 months worth of the option exchange. So this is what it's saying here. So all the way up until the September monthlies, this is the current gamma exposure right now. And this is for this upcoming. So the QTA page, which when it's available to you guys, it will always default with the next upcoming expiration, but you can always change this right here and jump to any expiration which you like, but I'll get to that in a second. This is saying the highest, largest positive gamma exposure. So these would be the strike prices which have positive gamma, and these are the strike prices which have negative gamma. We'll talk again a little bit more about that in a second. On top of that, we have this chart right here. So it takes the same information and it plots it on the charts, and it's just showing a day or 2 days worth of information, because again, the point of this is not to be charting, it's just to be able to visually see the options chain in a sense on the charts to kind of build out your trade ideas. What we can see here for this upcoming Friday right now, P1 is just saying the thick of the line, this is positive gamma 1. So this is just, I'm just calling it a P1 because it's saying this is where there's the most amount of positive gamma. P2 is the second most highest positive gamma. And then we have P3 all the way out here. So this is the third highest positive gamma, but it's so thin because it's not that large. And the same thing goes for the N. So N would be negative gamma. This is the highest negative gamma strike, 360. The second highest negative gamma strike is all the way up here at 370. And then we have 361. So we have, it's just 3 that we need to have some sort of an idea. And as you guys can see right now, we're kind of bouncing around this level here. Now you can use this actually before I'll show you guys how you can use this type of information in a bit. This will be up to date. So as the market is open, you will just be, you can, if you're ever curious, you can just come here and refresh the page and it'll recalculate everything as it's changing. And then if you're interested, if you are looking to be long and you want to know which strikes have the highest positive gamma, and you can already see which ones have high open interest and so forth. So the 367, if you're looking to be long, might be the call to grab. Now that's only 1 point out of the money. Maybe the 368 if you think it's going to 370, because that's likely if we were to do some sort of rally, that's more than likely where we're going to go and get stuck. Now as we scroll down here, we can kind of see this is a visual reference. Again, none of this is completed. Also, there's going to be a ton more added to this, and the intent is to have any changes whenever the gamma flips. Whenever the volatility trigger happens, the Discord will be notified. The same thing like right now we have whenever there's changes in max pains. Everything, the intent is to make your decision making a little bit easier, so you don't have to constantly keep coming and researching things. Because first and foremost, if you're day trading, nothing is more important than price action, volume, the tape. That's it. All the other tools and stuff like that are great, but they will distract you from being able to see this. Like if you are a scalper, you should be looking at the tape. You should be looking at price action, and you should essentially not be taking your eyes off of the chart because you are scalping. You're making all these decisions in very fast pace. If you need to take your time to go look at other things, it's going to distract you. If you're looking at, I doubt there's anybody in here that trades this way, at least not to my knowledge, but if you're looking for a MACD crossover, RSI divergence, and a EMA to cross over another EMA while, the moon is rising and while the stars are lining up in this pattern, and while you see some sort of pattern that looks like this, and then you're looking at a million other things, by the time you finally say like, okay, I should probably take that breakout, and then the breakout happens, and then you get in long here, you just missed the whole move because you're busy looking at a billion different things. Like that's not day trading. Like you price action. Even if you stripped everything away, you left everything alone, even QTA, you didn't use any levels for QTA, you didn't use anything, price action. That's essentially all you need as a day trader. Price action, volume, period. Now, obviously, we need some sort of an edge. There's so much high frequency trading. There's so much else going on. And every trader now has some sort of another edge over another trader. But again, I predominantly look at the options chain because, again, I feel secure in understanding that you can't hide this stuff on the options chain. There's so much other manipulation happening. Now, as we scroll down here, this is the spot price. The spot price is just the last traded price, the current price in which this page was generated. This was the strike prices, so the market's closed. So this is still showing from the 17th. So all this is like frozen in time from the market close. As the market opens, all this would show fresh. So if you're ever curious as to what timestamp in which is calculating, again, if I refresh this right now, it's not going to change because, again, the market is closed, and the SPY is the most amount of information it has to aggregate. Everything else loads tremendously faster because they're a lot smaller. As we come down here, we can see this is a massive gamma strike right here. We hover over it, we can see how much gamma it is. It's 367. One can make the assumption, if you are day trading, 367 is the level to watch for a break over 367 for a scalp up to 370. That is a 3-point move. That is actually a good scalp. You might meet a little bit of resistance right here at 369. So if you're just scalping for 2 points, that's great. Final profit target should be 370. If you're not looking at that down here, that's the intent of this, to just have this open during the day, and you can just have this generating, because every time everything is changing, remember, these levels are always going to be in flux because there's so many people changing. And as the spot price changes, this will be the spot price here. As the spot price changes, so does the gamma. The spot gamma is the equivalent to the gamma exposure for every strike price on the options chain at that point in time at that current price. So it all changes. Now we can already have the idea that once we crack over this P1 right here, this is the 367, we'll probably meet a little resistance at 368. However, if we can break and hold over 368, there's a good shot that we go up to 370. So you have a nice little window right here if you are scalping. This is for the expiration that expires on Tuesday, or is it tomorrow, on Monday? So this would be the 0 days in this case. This is just how you can use this just for scalping. If you're looking at a little bit more of a bigger trade, let's go down to the end of the week. This would be Friday. We can also see that each strike price has a different weight because there's more gamma exposure for different levels. So the weight right here is in this. So this is about 7.27% of the next 88 days till expiration. 7% is here, 17% is in this strike price. And then we can see that the biggest bulk is all the way here in these in the next monthlies. So we'll take a look at that in a second too, how you can build a trade here. But this is now, we're looking at it's for Friday. The gamma exposure 7%. We can see that it's largely negative still for here. So we can still, again, as long as this number remains negative, we can expect more volatility. It means the ranges will be larger. And why that's happening, I'll talk a little bit. We'll go over some of the stuff right here. I kind of shared this. Again, everything you need to know about gamma exposure, it's here. These are the guys that essentially published this, and this is when it really made, it caught wind back in 2020, and it opened the eyes to a lot. Unfortunately, I didn't discover this until around a month or so after the market recovered in March of 2020, and it kind of sucked because understanding this in 2020, you would have seen why there was no way you wanted to be trading puts going into this OPEX. And this was something else which I shared in the chat. This was that OPEX here. We went lower for another day. So that's something that I mentioned on Friday. So there's a potential that maybe we go lower one more day. Maybe we go higher. Don't know. Don't care. I'm already long. We go lower. I get long more. We go really low. I buy back the short calls and I hold the calls naked. I'm in the 365. So even if we go lower, I'm pretty confident, fairly confident we come back to at least 370. I'm not buying naked calls. Not doing that again because I bought the naked calls during this time here, and that sucked. Buying naked calls here on this bounce. Didn't take profit, sized into some more, and then we put this next leg down, and that kind of hurt because then when we finally rallied, those naked calls, they lost so much value because of time. I was in the options that expired here. Not making that mistake again. Generally don't do that. I always trade the following month because patience, understanding that it will probably take at least 2-3 OPEXs, weekly OPEXs, for the full move to kind of come to fruition, and then just keeping the risk small on the weeklies. So this was, again, I got a little greedy here. I was pretty bummed out about what happened here. Didn't really nail this. I took profit and I think somewhere around here, and this sucked. And I'm not much of the momentum chaser. So if I don't still have a piece, I'll let this whole thing happen. I'll just trade very conservative and small. And it's still something, it's been one of my problems as a trader personally. Not that you guys can care or it doesn't matter, but if you guys see me quiet after a move like this, it's more than likely because I'm upset, because I'm just like, Brian, what could I have done better to have stayed in the trade longer or have more size, that when I scaled out, I wasn't completely flat by the time we got here, because I know myself, I won't get back in the trade at all. I'll just wait. And obviously that's missing out on some opportunities. So then this time, psychologically, again, human trader, made the mistake. I was just like, I want this rally. I want to make 50 grand this week. That's literally what I'm telling myself. I'm going to put 5 grand in calls, and it's just like, I'm going to make 10,000%. It's going to be amazing. Right. And then this happens, a bunch of out the money calls that we just pulled back. And then obviously that didn't feel that good. And then it finally happens. But then psychology, by the time this actually happens, I'm nowhere near in the same amount of size. I'm so burnt out from seeing so much red from this. And then it just sucks. And then this move kind of happens. Now, again, granted, there's a different playbook I have, non-directional income-based strategies. They made up for a lot. So it's good. But if my only playbook was just momentum scalping or momentum trending days, there wasn't much money made here. Identifying two sigma, we're in negative gamma right now. So negative gamma, two sigma sell-offs. We can expect insane volatility. A lot of gamma just expired off of the market. There was this OPEX was it was the largest one, presumably since this time frame here, since the crash of 2020. We hadn't had this much gammas delta in the options chain that expired here. So it's kind of opened up the market now to presumably make another big move. Now, if we have some sort of bounce, the assumption is the next leg down will be even more aggressive as long as the market remains. If we have a bounce and we have a little bit of consolidation at this 50% retracement, so we go like this and we go like this, 50% retracement, this next leg down will be very scary because it's not going to be as much of the levels that were hedged prior. The new levels that are going to be hedged for all the way down here. So there's not going to be the market kind of, in a sense, it has not as much of a floor. And one way in which I like to look at the gamma levels is think of it as you're almost looking at the X-ray of the market and the skeleton, if you will. And the price action, which you see the traditional support and resistance levels, that's what you see on the surface levels. This can be, if you have if you have like acne or something like that on your face showing, that's what this is showing. But the problem could be something, it could be a gut health, it could be something in your stomach, it could be something you're eating. You need to look at it a little bit deeper. And that's when you're looking at something like the gamma exposure, it will in a sense show that a little bit more. So let's just jump back. Okay, we'll keep it to this Friday. As we look at this chart right here, so we're looking at this, we can see some of the levels. So one would make the assumption once we start passing, say for example, in any of the one strikes, so any of the highest gamma strikes, the market will more than likely have struggle to continue going in that direction, right? Now, the more negative gamma we are, the more the market is going to go in the direction in which it's going. However, once it gets too far past a certain point, it will actually whiplash right back. To keep that simple, I'm layering GEX because I'm going to do a couple videos explaining a lot more on this. And I don't want to spend the entire webinar just on this. There's a weird phenomenon that will happen. The more and more the market crashes, the sharper and sharper the bounce will be. And as we get past a level like this, 360 this week, yes, we might just flash down 5-point drop, but we'll probably see a 5-point pop right back up right to here. Now, if the market was to get over 380, we're definitely going to more than likely come right back down to 380, because if we got back over to 380, the volatility, the gamma flip is not calculated in this yet. It's the last part of the formula right now before I add a couple other things on. That's why I wasn't going to publish it until the gamma flip was published in here, because that's what I want the Discord to be notified whenever there's a gamma flip. Gamma flip would just be whenever this negative goes from a negative to a positive, as well as whenever whatever options chain we're currently trading. So again, we jumped to Friday, but let's just say we were looking at the 0 days. Whenever the 0-day gamma flips, and whenever I want us to be notified of it, as well as whenever the entire next 3 months options gamma flips, also want us to be notified of that, because that's important actual information that's not dependent on random stuff like other different things out there. Again, that wholeheartedly, the options chain is a large portion of what's going on in the market. Now, it's not the entire market, because if there was a complete macro catalyst that came out, all of this is going to change. So we can't say, that's why you must always remain flexible and fluid in the market and have risk management. You can't say just because you're aware of all these gamma levels that just because the market comes down here, there's no way, the market's not going to keep going low. Yeah, the market can go all the way down to 440. There's nothing to say that it won't. Like, anything can happen. It's electrical, things. There could be a hack. It could be a flash crash. It could be all sorts of different things that can happen. So yeah, you can be aware of the gamma levels and the open interest levels. You can have support levels on your chart. It doesn't mean the market won't just blow and gap down below all that and just keep going down. So it's just, you take everything with a grain of salt and understand that the same way, like, just because max pain is all the way up here doesn't mean we're just going to go all the way up to max pain. There's a little bit of context to things. And as we pull down here, we can take a look at this. We can see that max pain is all the way up here, but in order for the market to, in a sense, get past max pain, it's probably going to struggle around 374. There's a decent amount of gamma right here. It's negative gamma at this strike price, and it's going to struggle. Now, sorry for I don't know the level. There's a few of you guys, I don't know your level of where you're at in your trading career. So I apologize for just talking about gamma GEX so much without first and foremost talking about gamma. Gamma, if you don't know, if it's your first time hearing it, it's a derivative of delta, and delta is every time I repeat this, it just sounds so basic. I don't do a lot of beginner friendly stuff. And I always tell myself I want to work on that. I enjoy talking to more intermediate to advanced traders, and the traders in which I'm usually on the phone with for hours a day, or they have 10 years experience. I get to talk all day long without explaining things. So if ever I'm explaining stuff and I don't, talk about the introductory stuff, apologize. And then if you've heard me say this a million times, I also apologize. But gamma is a derivative of delta. And if you don't know, delta is for every 1 point that the underlying goes up. And these are all simplified explanations to things, but for every 1 point the underlying goes up, that's how much your option contract will change. So if I wish to just mock this up, let's take off the trade in which I'm in, and let me actually just grab. So again, I'm short these strikes, I'm long these. This is just for the Qs. Right now, I'm in the SPY, I'm in the IWM, I'm not in the Dow Jones yet, but let's just jump to Friday. And let's just say I was to buy this one right here. You can see this is the delta. The delta is 0.51, and at the money option is usually going to be around 0.51. It's either going to be in the money or out the money, right? So remember when we said that the delta is essentially, some people use it as a measure for the probability of it being in the money or out the money. If it's at the money, it's either going to be in or it's either going to be out. It's 50-50. The further and further away you go from that, the less and less chance it has of being in the money, because you're asking for the stock price to make a bigger move. So obviously it has less chance. If we go to the risk profile, I'm now in this at the money call. The delta is 50. Let me just make sure I'm at the today's date. Yep. So let's jump to tomorrow. So the delta is about 50. The gamma is 3. So it means for every 1 point, let's move this up right here. So let's go from, we're now at, we'll call this, let me just put the actual numbers in here. The cents are going to drive me crazy. So 275. And then let's just say 276, right? So just move that up. So this is just, and then we'll delete, actually, we'll add one more, 274. All right. So here are our strike, what would be referred to as our spot prices right here. And we have, as the Qs are at 275, this is the delta. The gamma is 3.1. As the Qs go up, the delta is going to increase by the gamma and a couple of the other Greeks. Again, volatility affects things too. If volatility increases by 1%, this is how much this contract will increase in value also. So they're all interchanging. They're all, in correlation with each other, which is why the Greeks, your options prices are essentially always fluctuating. Gamma is highest at the money, and it's also highest at the closest expiration strike. So we're trading, this is options that expire this Friday. The gamma, if I was to jump and change this to the 21st, you see how the gamma is the same strike price, but you see how the gamma just jumped up right here. And the further out in time, if I was to go to, let's go to like the 15th or so, you see how the gamma is a lot less. So the options price is a lot more sensitive to gamma the closer it is to expiration date, which is why if you've ever heard of Seth or me, when you guys ask questions in the option spreads or the income spreads channel or anything like that, and you say, oh, why don't you hold it for more profit? It's just, we're essentially trying to avoid any type of gamma risk, because it's not about, we're just looking to locking out 10 to 15%. It's an income-based spread. I want to know I'm getting a consistent 10% return on whatever I'm putting out there. So if I have 10K in the trade and I'm looking for a 10% return over 2 weeks, I want to know that I got $1,000 coming in over the span of 2 weeks. Even if the contract expires, it still has 4 more weeks on expiration. I'm closing the trade, because the closer and closer it gets to expiration, the gamma starts increasing, and the gamma increases is going to affect the delta. And if I'm in a non-directional trade, I don't want a lot of exposure to delta or gamma. And a market maker, they don't essentially they don't want any exposure to delta. So as we look at this, and we said strike price goes up 1 point right here, the delta increases by the gamma. So for every 1 point the underlying goes up, we're going to see that the delta is increasing. And the further and further away we go from at the money, the gamma starts decreasing, because now let's actually just pull this back right here, because we don't need to go that far out. This right here is an assumption of the P&L. So if the market was to rally to 280, and then let's just say by Wednesday, this contract will be up $139. If the market goes nowhere, this contract will be down because of theta. As we know, when you buy an option, you're losing this much. So theta is hurting you. Vega is helping you. You want to increase in volatility. Gamma is helping you when you are buying a contract. Now, the gamma is just the rate of change for delta for every 1 point the underlying moves. I'll say that a little bit slowly. For every 1 point the underlying is whatever you're trading. In this case, is the Qs. So for every 1 point the Qs go up, the delta is going to increase by whatever gamma is. All right. Now, when you buy an option, that's good for you. You want an increase of gamma. All right. Let me close this out. All right. And then let's go to a long call. And let's pull this right here. You buy a call, you have an infinite profit potential. Obviously, you're not going to make infinite money. You probably have a profit target in mind. You know your max loss is the price of the contract and so forth. Now, the dealer, who is the market maker is often called the dealer. If you read any of these white papers and stuff, whenever you see anything when they start talking about the dealer, that's who they're referring to, is the market maker. If we were to be a market maker, and let's just say, let's use puts for examples, because puts are more fun to talk about in this. If I was to buy this 360 put, I will only make money if at expiration the market is below this break-even strike price. To a market maker, they are on the opposite end of your trade. They sold you the put, so they are short this put, which means they are short gamma. All right. And if we swipe this right here, we can see the Greeks. Their gamma is negative. That's not good, because it means for every 1 point, this option goes, every 1 point the underlying goes down, this option is going to increase in value for you, which means on the dealer's book, the book is, you know, their all of their positions, open positions. This is a negative gamma position right here. That's a loss. That's how much they're losing for every 1 point that's happening. They have to offset this risk. They don't want, that's why this is their exposure to this risk. Delta hedging is when you want to make sure you have no risk to direction, so you can cut this in zero. So what a market maker will do, what they can do, if they were to sell you this put, they can also, because they have a positive delta position, they can also short stock. If they were to short 33 shares, their deltas essentially will cancel out. What happens is, if the price keeps going down, the delta is going to change. As the delta change, they have to short more stock, equivalent to how much the gamma is changing delta. And the same thing for the other end. I think I can just talk about one example. So this right here, the reason why this is so important, why everyone pays attention to this once they get to the next tier of options trading, or start understanding a more deeper level of what's happening in the options market. Again, trying to keep things simple for you guys. And say, whenever the VIX is really high, or the VIX is over the QTA 2 sigma levels, we're generally in a negative gamma environment. Whenever the VIX is over the weekly sell zone, we're more than likely in a negative gamma environment, and volatility increases. The VIX is a good indication of negative gamma and positive gamma. And if we were to pull up the VIX for a second here, and do I have it on this computer? I don't know. On my other computer, I have a different chart here, but let me see if I were to put on, nope, the implied volatility. Okay, yeah, so I have this here. So negative gamma, definitely anytime VIX is up here and it's implied volatility. Whenever the VIX has extremely high implied volatility, gamma is extremely negative, right? Whenever we're down here, gamma is nowhere near negative. So I'll probably share some levels. I'll actually put them on and try and share them so you guys can just have this. This is built into Thinkorswim, just so you can have some sort of idea. Again, eventually you guys will have, after I'm talking so much about it, I'll probably release it earlier this week so you guys can start playing around with it, but it won't be the finished page. But if we are in a negative gamma environment, what the market makers are going to do is essentially trade in the direction of the trend to keep it simple. So let's pull this up here. Let's hide this. When GEX is negative, this is after you read the entire white paper, and the easiest thing to take away. When GEX is negative, as price is going down, market makers, in a sense, have to keep shorting also to offset their gamma risk. And that will keep happening until implied volatility gets so high. And again, I'm oversimplifying a lot. The whole thing collapses on itself and price just whiplashes back upwards, right? When GEX is positive, market makers, they don't need to do the same. They don't need to do They don't need to trade in the direction of trends. You will get compression in price action. So as price goes up, let's just say now this is the gamma flip. So now we're in a positive gamma environment. As price goes up, market makers will sell, and then they will buy, and then they will sell, and then they'll buy, and then it will have a the price would have a very tight range. And then if it just keeps going up casually, if as long as it's not going up too sharply or too fast, there's no harm, no foul. The market is just doing what it's supposed to be doing. There isn't much happening here. It's just a more normal trading environment, not like what we're having, where the gamma is also not supposed to be as negative, in which we're having right here. And I'm pretty sure these guys, once they publish this, I think they gamma is very rarely negative, or it's supposed to be. Again, this was published in 2020. We've been getting we've had a lot of negative gamma this year, but this graph right here is a representation as to what I was just explaining. This right here, as this is the change in price right here, and you guys can see it's very compressed. There isn't a lot of volatility. This is as gamma is negative. Look at the ranges. The range starts opening up. It's very, very volatile. Negative gamma, positive gamma. Now, if you know which side of the play, the market, which environment the market's in, you can adjust your playbook accordingly. On top of that, we've seen that direct correlation. When the option spreads, when the data stats page was released, I believe wrong page. I mentioned something like that to you. Oh no, I think it was on a couple one-on-ones I did with you guys. If we just were to jump to, let's go back to, let's start with 2021, and we just look at this graph down here, we can in a sense see the volatility that's we had a little bit of a contraction, and we can kind of see. So each of these plot points, this is because I'm looking at the daily candlesticks right here. This is, each one represents the net change for the day. So this day that was the net change. This day is that net change, and then this right here is the one standard deviation. So on average, market for the past X amount of days, 365 candlesticks. This is 367. This is essentially supposed to be what its one standard deviation is, which is about 68% of all occurrences happen to be within here. What's happening right now is we're getting so many days that are way without. It's not statistically normal to have this much outside of their standard deviations. If I were to, let's just get a larger sample set, just to also paint this picture to you guys. Generate this. Okay, we can kind of see here a little bit of compression and then expansion and expansion. Now this table down here, it has the VIX is included for all of this. So you can, and this is, you can download, you can play around with this data all you want. You can export it into Excel and all that stuff right there if you want to see if you can find or maybe spot some other type of correlation right here. But whenever VIX is high like this, we're generally going to be in a negative gamma. In the future now, QTA I'll have another table in which it will actually have the GEX stored here for mostly the SPY, and probably the main tickers in terms of the options chain on the market would be the SPY, Qs, and Tesla. Those three are in a sense the largest options chain. So QTA will be a little bit more focused in on just those, as opposed to providing this page right here will be for any option. It'll be just like these are not limited to QTA tickers. You'll be able to use the gamma explosion for any stock. However, for the way QTAs, the algo is going to be reading constantly the SPY, SPX, SPY, Tesla, and Qs for now, and that's when it's going to be a little bit more intimate with, as I try to do, come up with something a little bit more advanced and proprietary to help with actual trading signals, as I try to improve the trade ideas to incorporate some of this information. But that's all for Q3. As we look at this expansion here, we see this negative, us being in this negative gamma environment. Let's talk about, let's see if I can explain this without being too confusing or anything like that. Okay, so back to this example. If I was to short this, I'm a market maker and I short this. I don't want the market to go down. I make money if the market goes up. Because you bought this, you make money if the market goes down, because you have a negative delta and you have a positive gamma. You're like, yes, give me all the volatility. Market maker, they don't have a choice. Their function, their main function, their role is to make a market, which means they're always there to provide liquidity, which means if you're trying to buy a put, chances are you're buying the put from the market maker, because a person with small money is not selling a naked put. So market maker is going to sell the put, but they can't take the direction. They can't take this risk. They just can't. So because they're doing this the market makers in Chicago, and I think it's maybe like 5 or 6 large ones, right? And they're institutions. It's not like a guy sitting behind his computer selling you a put, right? It's an institution, and they have to provide liquidity for this entire options chain for every single strike price for everything. So if you wake up on Tuesday morning and you're just bored out of your mind and you say like, I'm gonna buy a 290 put because I'm cool and just go for 3 cents. The person on that other end, you're going to get that from a market maker. It's not going to be somebody, it's not going to be me selling you that 290 put just because it's a market maker doing that. So all this open interest, majority of it is, it's not all, because obviously there's some people that aren't a market maker that can sell, but the assumption is, I don't know the exact number. They didn't mention the exact number in the white paper, but let's just say we take a guess and we say 95% of all the liquidity in the options chain is provided by a market maker. They're the ones writing all of these contracts. And that risk, they can't go selling naked puts, because if you ever sold a naked put, it's never, if you ever sold a naked option, period. I almost put my fund in about a $400,000 market call last year when I was short 20 SPY calls naked. And I have no restrictions on the account. My orders won't get rejected. So if it was very scary, I ended up being right on the trade, but like we got the margin call the following day. I didn't know I was supposed to do that. And again, it's not like a retail platform where they'll reject you for the BP. The clearinghouse is the one that will confirm it with the broker, and we get the letter the next day. So it's a scary situation, but you can be down 400%, 500% if you're selling same day expiration options. And because you could be shorting a call that's 10 points out the money and just trying to collect 10 cents. And if you sell 10 of those, you're just trying to make $100 because you're supposed to have a 99% probability of making money. It doesn't mean $100 might be your max profit. Your max loss might be 100 grand. And well, your max loss would in theory be infinite, because the market, presumably it could in theory go up infinite percent in a day, but it's not going to. So it's a scary situation to be in. The way you counter that is you hedge your delta by buying stock. So let's look at a simpler example. This is how I've taught it on an individual basis. Let's switch this to a call, and hopefully if I haven't, oh yeah, this is a call here. So I've now purchased this call. This is my T+0 line. So this is my profit and loss as price is going up. It's good for me, right? Market maker, it's not good for them. Let's go to further data out, because the data is killing this option. As you guys can see, like even if the market was to bounce and I'm still holding the Qs was to bounce, I'm still holding this put. My break even is all the way here. That's upsetting. So let's just go with the next the next month, July 15th, just because data is going to be less. And there we go. Now we're actually green. See, $66, and we don't need a large move. That theta was insane. Now the theta, we just cut the theta down significantly, which is why I like trading further out options. But anyway, as we look at this, if I was to put this like this and short this right here is the P&L. So let's just say the market did rally to 280. The loss for shorting this, if we were to go to like the 24th, is $200. This strike price, this is the 275 on the Qs. So let's take a look. Let's see. 275 on the Qs. The open interest is 23,000. So let's just say I am that market maker that sold or wrote the 200,000. Okay, that's the net P&L if we went 5 points in the money by this Friday, right? Which is very possible. That's only 5 points on the Qs. Like the Qs is moving about 10 points right now. So a 5-point bounce in the Qs, that's the P&L on the book. That's that, and with still in theory, if we went all the way up to 285 or so, it can just keep going exponentially. That can't be, that's just not allowed. So the delta on that is this at this time. If we jump to today, and if the market was to go up, yeah, we'll keep it at 280. Nice whole number. That would be the delta, and this would be the gamma. So to hedge or to protect this, I can then come in and buy the stock equivalent to this delta, right? So let's see if, how do we can, I've actually never added stock on here for the simulation. I think, can I add it here? Nope. I've done this on, actually done it with smaller numbers on option strat. Let's hit the bid here, not sell. Oh, the zoom is blocking. Here we go. Let's hit the S, buy. All right, and then let's come back to the risk profile. Now we're buying stock, and let's try to, you guys see as I'm increasing, let's jump this by 5,000. Let's go, let's add a 50 here. Okay, so still, let's add that. You guys see what's going on with this T+0 line? Let's add another. Okay, let's take a 0 off. All right. Let's take a 0 off. Okay. Obviously, this is not what a market maker would want because now this is a direction. Let's actually now just put in the 3, 8, 1, 3, 3, 4, 3. Okay. Deltas are constantly changing. Okay, so let's go to right here. The active price would be, sorry, I'm going to put this number in now, 2776299. All right. Right here, protecting these numbers are not obviously matching up 100%. I'm just trying to show you guys flattening out this curve. I'm not going to try and do the exact math right now and get the perfect match. Let me put in 0 here and see that. Bring it down maybe 1.500. Okay, so now we have a little bit flatter again right here. The whole point of what I'm trying to show you guys is by buying stock equivalent to the delta, I can keep this flat, but I can't account for when we get up here, because as we get up here, the slope starts increasing, which means as price starts moving higher up, I need to buy more stock. So for every 1 point that the stock price goes up, I need to buy more stock, as well as buy stock. I'm buying stock equivalents to the gamma, because remember the delta, I'm trying to delta hedge, but the amount that I need to delta hedge is based on how much negative gamma there is out there for me in this particular case. So that right there, in a sense, that's delta hedging, but I'm delta hedging based on my GEX, which is my gamma exposure. And that's what's occurring, because without doing this, the risk in which I'm taking is way too high. Because if we turn this off and we went even, let's just go 1 point up. So we went to 276. If we go 1 point up, I'm going to be down $1.3 million. What's the fastest way to offset $1.3 million? I don't know, maybe buy the equivalent in stock, but it's not the exact amount of stock I would need to buy. It's the amount of deltas that I'm short. And if hopefully, let me see if there's any questions, because I haven't heard from anyone, so I'm hoping I haven't lost you guys completely yet. And normally I've shown this, I've taught this on a couple one-on-ones, and it's a little bit easier because I get questions along the way, so I can pause. But I'm just operating with the assumption you guys are all following. Now, because the market maker can't have this, because this is one strike price on the options chain with 20,000 open interest right here. There's also this one. There's this one. There's this one, and this one, and this one, and this one. There's all of them, but look at how large these are. And for every 1 point, or it's not necessarily every 1 point, it's every time price moves, actually. We're just using 1 point because we'd be here all day trying to calculate every single decimal point system. Some proprietary systems use a 1% increase in the underlying. Some go by a 1 point increase. There's all sorts of different algorithms and formulas out there, right? So for every increase in the stock price, the underlying price, you need to offset, as a seller, as an option seller, you need to offset your gamma risk. So you have to keep buying. And you guys have probably heard the term gamma squeeze and things like that. I was explaining this on for Tesla. That I have a couple of videos on because I love the Tesla gamma squeezes. They're amazing when they happen. During a negative gamma environment, the market makers are going to have to short more aggressively. It's just the way the model works. And if you want to understand, again, more of why, it is explained here. And this is one of my favorite white papers there are out there. It's a little bit of using the Black-Scholes model in terms of calculating the delta of for each time the spot price changes increases a certain percent, what's the implied increase in the volatility of the option for every single strike price on the options chain, what's likely to happen in the change of gamma, and then how much more of a stock is needed to purchase. So if the SPX is at 3,000 and then the SPX drops down to 2,900, this would be the delta. However, if the SPX was to drop, 50 points or so, or go up 50 points, this is just showing the model in terms of the changes of the delta. That's how much stock would be equivalent of the SPX would be needed to purchase. The notional value are the numbers are huge. They start entering the billions and so forth. And in my opinion, it doesn't make much sense trying to understand the actual billions of dollars that's equivalent. But what it ends up meaning is for every 1 point that an underlying will go up or down, the amount of stock would need to be purchased or sold to offset the gamma exposure. What ends up happening when we pass a level like 360 is if implied volatility keeps increasing, the amount of short stock has to also increase to match that until implied volatility just kind of halts and does not go up anymore, which is why I've repeated for the entire year is just saying, guys, if you're looking for the bounce trade, just look for the implied volatility, look for the VIX to decrease. That, in a sense, I haven't published the article. One of you guys actually went and took a bunch of the things which I posted in the Discord and turned it into a PDF, excuse me. And let me see if I can find that one there. And I will put this on the resources tab, but it was this particular time frame right here. This is whenever this, in a sense, has happened. This is a short tell sign that we're going to get. This was on the right-hand side here was the VIX. This was on March 8th. This was too stark of a contrast between where the VIX was when the SPX and the SPY, in a sense, did this double bottom, and this was 2 sigma right here. So whenever we are at 2 sigma and we get some sort of like, this is a few days difference. If the market double bottoms this week, say, for example, and the VIX has a 8 or 5 to 10% contrast between where it was and where it currently is, you almost have to do your job as a trader and put risk on being long. Even if nothing's 100%, it doesn't mean it's going to work out. But you have some of the highest odds for this, in a sense, to happen. It will generally happen whenever we have the insane premium imbalance. Usually the number was whenever the puts are over 35 million and the call premium was below 5 million. That was kind of the sweet spot. But now again, the entire market is so severely in this negative gamma state, but that's because we had so much open interest and so much volume that just expired this Friday. So now things have, in a sense, opened up, and we can look at these gamma levels here for this Friday, and we can say, okay, so 360 is a very key level. We can see the open interest here is 22,000. Here's 21,000. So there's definitely, there's someone that's probably going to start their day off, if they haven't already, by actually selling the 350 put and buying the 355 put as some sort of put credit spread, with the assumption knowing a lot of gamma just came off of the market. We're expecting some sort of a little bit of a relief rally. These puts are likely to expire out the money just because of where we've gone. So I'm pretty sure there's some traders that are going to use these gamma levels that way. The ceiling, in a sense, for this week will probably be 380 if we get up there. I mean, and we know max pain would be likely to come down, so it might end up landing somewhere in this spot here. If you take the approach, say for example, you want to jump, for me, when I'm structuring some sort of an income-based trade, and I were to go to, let's go to the next monthly, because this is where the most amount of weight is on gamma. Once this expiration is done, a lot of gamma will come out of the market, but then it will in a sense be added elsewhere. And if I was to pull this up and scroll down right here, I can see, so a key level of interest is 350. So we have 350 down here. Max pain is all the way up here. But if we look at the chart, and I might tell myself, okay, let's see how this is looking. I would feel fairly confident by saying, like, okay, the market's going to struggle to go lower below 350 again, unless if the CPI numbers come out and they're over 9 or 10%, well, we're going another 5-10% down. Like the gamma or no gamma, the market will just be in more negative gamma, and the gamma levels will just update. They would change. Remember, these are always updating and changing, but for the most part, unless it takes catalyst, it takes a news-driven event to break models. And that's a sense what we got with the CPI numbers coming in higher than expected. But granted, if there's no catalyst and there's nothing unexpected happening, then the market is just going to do, in a sense, what it's programmed to do. There's all these models and machines and quant firms and all these type of things out there that are just running these algorithms based on certain models. Again, granted, unless news change, and they're the news-driven algorithms that come in and change up the models. And that's why everything kind of happens so fast. It's because of all these machines reading the headlines and aggregating, sentiment and all this stuff that's out there. Now, if I'm aware of 350, we can see this clump of all this gamma up here and max pains up here. I might tell myself, for me, the type of trader I am, I'm like, okay, I'm looking to put on another income-based spread here. So maybe I'll go with an iron condor. I'll go out to June 15th. And then we have a 400. And then, probably put this, make it about 5 points wide. And then what's the other level? We have 350. I might say, let's come in here and say, like, what kind of iron condor can I get for 350? Let's come down here, make this one 5 points wide also, pull this in, and then let's just bump this up to maybe about 5. And I might tell myself, okay, this is obviously, it's an offset, it's not necessary, it's not completely a non-directional iron condor, but I might say I might have a little bit of faith in this 350 level holding, but because it's an income-based spread, I have so much room to the upside, I might as well maybe just give it a little bit more room to the downside just to open it up a bit, and might say, okay, yeah, by the 15th, this is the 26 days till expiration iron condor. I generally only hold these things for about at most 10 days or so. So if I'm telling myself, okay, so by next week, let's say next week, Wednesday or so, if the market's around 360, what's the expected return on this? If I usually run these on the SPX, I'm using smaller numbers for some of you guys that might be new to the iron condors and just the thought process behind it. 15% return on capital if the market is anywhere within this vicinity here. If we are all the way down to 350 for whatever reason, we'll be down about 8%. Stop loss would be around 15% if I make absolutely no adjustments, but you guys know I make the adjustments around the QTA levels. But if we were to pull this here, we say, like, okay, down at 350, and that's the level I expect it to hold. I'm only going to be down $167. Okay, yeah, that's awesome. And then if I think the market's going to bounce, then it'll take a couple more days to bounce, and then maybe by that Friday we do bounce and we come back up to here, and then there goes $300 on a trade, which is over 15% return on capital. And again, with the SPX, I'm usually I stick to around, for me it's around $6,000 to $10,000 per iron condor on the smaller end. I'm running a large one, it's going to be around 20 to 25,000, and I'm working my way up to getting to the point where eventually I'm running these types of trades using 1.5 million to anywhere from 150,000 to 1.5 million. Again, this is not my capital, this is money from the fund that we're trying to get outside investors or that we're doing this for. So that size, I'm personally not doing that with my own money. With my own money, I keep it around $10,000 is the size I'm comfortable with, and then I use another account in the fund, and I never go past about 25,000 personally, if you guys ever wanted to know, and it would be on the SPX. But my thought process behind this types of trades is, if I'm looking at this, I'm like, okay, so I'll be down $300 here, and this is a trade that I'm not doing much with. Remember, it's generating income on the sidelines here, and if we do bounce, I'm expecting about $500-$600, and the thought process is, this is just in how many days is this? This is 12 days from now or so. The whole intent or the point of the income-based trades. And if you guys notice, I went flat this past week and I didn't open up a single income-based strategy because I'm expecting too large of a move this going into this next week before I feel, confident. Now I'm not purely an income-based trader. Purely income-based traders, 52 weeks in a year, they don't care what the market's doing. They always have these running no matter what. I'm too much of a hybrid. The little bit of discretion kicks in. I know too much about all this other stuff that's happening to say, like, I'm just going to run an iron condor. I don't mind waiting a week, put it that way. Now, as we come up here, the income-based trades here, it's about having them overlapping. So if I set one like this up for this week, a few days passes by and a week passes by and the market's, kind of hovering around here, I'm going to open up another one. It might be then an iron fly, and then it's going to be based on open interest levels, gamma levels, and then I'll by the time it's the way I've explained this to new traders is, think of it as if you're planting a tree, and in a couple of weeks it's gonna bear fruit. Usually it's within 7 days, but I'm using 2 weeks just because of how crazy things are going. But generally, for the type of, these are less than 30 days till expiration, these types of trades, the return, you'll get them within 7 to 10 days. And if you have to make an adjustment, then it's going to take maybe closer to 10 to 12 days. But without an adjustment, you're hitting your profit target within 5 trading days, 7 days in total. Usually on the higher end, it's about 10 trading days. Again, if it's under 30 days till expiration. Now you're talking about, okay, so this is a $500 return. And by the time I'm realizing the gains on this one, I already have another one going. So the following week later, presumably I'm realizing another $500 return. And then it just keeps going. And that's the intent behind this. But if you have the information and you are aware of certain gamma levels, and you can tell yourself, like, I use them in conjunction. It's not just the gamma levels. It's also, for me, what's important is the open interest levels. So the fact that there's so much open interest here below 350, the way this can be hedged overnight is with futures. And that's why you'll see the futures will make huge moves, because if there's a lot of gamma exposure here and the market opens up after 6 p.m. Eastern time and we're already below that level, and the market ends up opening up the next day down 2%, that 2% gap down is because dealers had to come in and short the futures overnight. They couldn't wait for the market to open to offset their risk from their options, their short option positions. They have to start from the night before. And I've been in that situation many times with my own trading. Let's just say I'm in to put in perspective, the days in which I'm scalping a little bit more, it's more than likely because I have to actually offset my own delta, and because I'm in a non-directional trade. Let's just say you ran a calendar. And again, if you don't know what a calendar spread is, it's just to not explain another concept. Calendar spread, let's just say I'm in a calendar spread. Just think of it this way. If you're new to this, it means I want the price to kind of hover around 380, right? We'll just keep it at that. So this is my bullseye, and I'm saying I want the price to just kind of hover around 380. If that's the case and the market gets to 380 and my calendar spread is green, and I'm probably up 20% or so. Well, if you get a calendar spread from 380, to show you guys what type of return can come from a trade like that, because it's an out the money calendar, which means your return is going to be really nice, especially if you can get it on the exact right week. So 380 calendar spread right here, out the money, and this one expires this Friday. Let's just say the market did rally up to 380. By Friday, max profit would be 370. It would probably be closer to about 330, because implied volatility would come down a little bit, and the tent will shrink. But let's just say you get it for $1 and it's going for about $3 a few days later. Now, if I'm in a wider term structure, right, or a longer dated iron butterfly, let's go with Friday. The distance between these two strikes is just what's referred to as term structure. So if I want a wider term structure, I would go with something like this. But let's just say I don't want a wide term structure. I'm keeping it just from a Friday to Friday. I believe, the 15th is a Friday. So Friday to Friday. And I'm in this calendar. And by this Friday, the market is hovering around my strike prices, and I'm up 24%. Again, with the SPX, that would be $300 right here with just one of these. And I would be using $1,000, $1,300 in capital. And we're here. I'm going to tell myself how I want to stay in this trade as long as possible, because the more time passes by over the weekend, now come Monday, I'm going to be up a little bit more, now $48. If I can hold it for a couple more days, I'm going to be up about 60, because the more time that passes by, the calendar is going to benefit from that time passing by, because it's a positive theta trade. It's making $1.66 a day. And again, this size is way too small for me, but let's just say 5. I want to keep it relatable for all different account sizes, right? But here we go. So now Friday, let's just rewind this. I'm up, you're up, whoever's in this trade is up $163. And then you're looking at your risk profile and like, okay, if I could stay in this trade by Wednesday, I'll be up $300. I'll be up a whole other 100%. At 380, guess what? Your delta is 0. If I was to mock up another calendar, but this time we go at the money, it's non-directional. See, the delta is less than 1 here in this case. All right. That means it doesn't really matter, because as long as the price doesn't go anywhere, you're going to be making money as long as it's hovering, which is when we're running non-directional income-based iron calendar spreads. We're going at the money, and we just want price to kind of stay within a range for a few days. Now, if you're doing it out the money, it could be at the money too. But for this example, let's just say you're doing out the money and the price gets to your strike price, which is, this would now become the spot price, and your delta is 0. Your problem now is just how much is the delta going to change if the price moves based on gamma. So now you end up in a situation where you're like, oh crap, I don't want anything to happen. Please, can the market just consolidate for 2 days? Can it just stay here, because I'll make an extra 30-40% for doing nothing? What ends up happening is, anytime I've been in this situation personally, and that happens, and I'm in the SPX, I am trading the futures, because if I'm at 380, it means if we're above 380, I'm buying a futures contract. Because at every point we go higher, my calendar is going to lose a little bit of value. I'll get the MES, which is 1/10 the size of the ES. So depending on, depending on how much I need to offset this will determine how much of the MES contracts I need to get. And this could be after hours, it could be during the day. I'm going to leave this trade on, but because it means the higher we go past 380, my calendar spread is going to start losing money. So I might get in at the money. I might get a couple futures contracts, and then as we pull off of the level, I'll just put my stop loss at break even. If we come back down and I get stopped out, okay, cool. Now we're going a little bit lower. If we pull away from level and just get short, put a stop loss a little bit over it. That's why you'll tend to see a little bit of chopping at certain levels. I'm one trader doing something like this. Can you imagine an entire institution with hundreds of billions of dollars or hundreds of millions and billions of dollars in the market, and or you're some sort of market maker, and you'll notice pinning at certain strikes? It's because they're trying to offset their gamma exposure and or keeping or delta hedging. In a sense, it's essentially, again, if it hasn't made sense by this point, you're trying to offset your delta, but your delta is changing based on your gamma. So this is your exposure, but this is how much this is what you want to make sure is close to zero, because you can't gamma is going to be fluctuating. That's going to keep really fluctuating again the closer and closer we get to expiration here. And once you're at the money, it's extremely sensitive to it. So as we're here, you're gonna find me like the last time this happened to me was funny. It was when the SPY was at 4,100. I hadn't traded the futures that much in a while. It was this not this time, but right, or I don't remember. I think it was around this time here. A couple of these days here, I was scalping like crazy, losing my mind because I was in a couple of really good trades. And I wanted to hold them for a couple more days. It would have squeezed. That would have been the difference of being up 40% to being up 65% or something. I was like, man, I want to stay in this as much as I can, but the market was driving me crazy. But I was just scalping all the way. I went nowhere with the scalp, and the amount I'm paid in commissions was crazy. But it was just because I want to just make sure if we made a move like this, I was long. And if you guys ever heard me say I'm long because I had to be, it was when we broke over 400. This was the last time right here. Once we broke over 400, I had to buy futures contracts because I wasn't positioned. My non-directional trades wasn't positioned at this time for this. We were in iron condors here. The iron condors were fine, but once we broke past this level, this iron condors started going red because they were not positioned for us to go over 400. Did not expect us to rally past 400, but that's what happens in a negative gamma environment. The dealers will have to start buying back stock as aggressively as they were selling them. And I'll mention, I've talked about the VANNA trade and the charm trade in a while in the chat, but as implied volatility comes down, VANNA, which is it's a term used for when IV comes down, the option delta decreases. And I don't want to, I'm running on time here for the webinar. I just glanced at the time. I didn't realize it was so late, but so I won't over explain this. As implied volatility comes down, the delta on option comes down. And if you're a market maker, what are you offsetting? Your delta, right? You're keeping your delta as close to zero. That means if the delta is coming down, that means you don't need to have as much stock short, which means you can start back buying stock. That means prices are going to go up. All right, that's VANNA. Charm now is just as time is passing by, so is the price, the delta of the option is going down just because time is passing by, which is why if something is just consolidating, if the market drops and it's kind of just consolidating and chopping around the lows like this, it gets exponentially harder and harder to remain short, because as that IV starts coming down, you can just look at the VIX. As the VIX starts coming down, dealers are going to have to just start back buying all those short positions they were in, and we're going to get some sort of a rally here. Again, if there's a major catalyst, CPI numbers, that breaks a lot of the model. So as we come to a certain, this here, I had to go long. I just bought the moment we broke over 400, couldn't even think about it. It's like grab futures contracts. Glad I did. This would have been a massive loss for myself because I was actually short the 400 call and I was long. I think it was either 410 or 405. I don't remember, somewhere in the income base spread Discord here that week, whatever it was. And it was trade ended up, didn't take as bad a loss as it could have been, because this right here, once we cracked over 4,000, actually made the adjustment to the iron condor, but then I also had to be long the futures once we broke past 400 the following morning. Was not even couldn't even think about it. It was just like get long, and just to protect from this presumed rally that was coming right here. It's the same thing that all option sellers have to deal with, because there's nobody shorting 20,000 calls naked and going to sleep at night. And during a bear market, even if you're selling calls, you're scared because one, rip your face off rally and you can blow up a whole, you can blow up a whole fund. If you're, especially if you're a mid-tier fund, if you only have $10 to $50 million in of assets under management, yeah, you can't short calls and just go to sleep at night. You have to be long something. And the same thing, you can't just sell puts. Now the thing is, in a normal market, the way this works is calls are sold to finance puts. So during a normal bull market, we don't usually get these rip your face. We don't get these during a normal bull market. Again, this is a bear market rallies, right? We get these big aggressive rallies. During a normal, when the market's just doing this, if the market's here, you can sell the next you can sell every monthly option, maybe a certain delta up, because the assumption is going into the OPEX, the market will just come right back down and just kill all those calls. As the market is going up, we start approaching close to an OPEX. We just kind of kill all the calls. You know, the market just loves doing that. It goes up, everybody sells his calls. It makes you nervous. You're like, oh crap, the market's going up. I sold all these calls, losing money, and boom, by expiration, calls are worthless again. Market goes up, boom, kills all the calls again. Market's going up, boom, kills all the calls. Sell the calls. The market's going up, sell the calls. You use that money though as a fund, as an institution. You sell calls to buy puts, because you need to hedge your assets. You actually have equity in the market. You have stock. You're not a retail trader that just has, $5,000 in your account. You own no stock, and all you're doing is just day trading every day because you're trying to make $200 a day. That's not the business model of an institution. It's about investing. It's about 5, maybe 10-year plans. It's quarterly growth. It's not a daily. They might have 2 bad quarters, 3 bad quarters, maybe even a full red year, but it's because the entire market's pulling back. And then in the 3 to 5 year plan is just how can we mitigate as a fund the losses when the market is pulling back, as we continue to acquire positions in companies as the market kind of reverses, because institutions will start will come in and be buying at lows. Institutions are not buying at highs, and you can see it. That's why as aggressive volume comes in, panic selling coupled with aggressive buying. And the 4 phases of the market, if you didn't know, phase 1 is accumulation, phase 2 is the markup, phase 3 is the distribution, phase 4 is the markdown. So this is 1, this is 2, this is 3, this is 4. We're currently in phase 4 right now. Phase 4 decline. We will eventually enter in, the market repeats itself. We will enter phase 1 phase again. We will enter phase 1 again, where the market is being accumulated. The accumulation, no one ever knows how long these things will take. And you won't even know you're in it. You'll just look back and be like, oh crap, I wish I was accumulating some stock, during that time. There's certain tickers out there, something like, I'll just throw this one in. I try to refrain from talking about individual tickers or whatever, but I can't wait for shop to hit 250, because down here, I would love to be 250 is down at this level here at 250. I mean, we have 60 shares I'm managing right now of shop, and the next 40, which I'm getting, is at that level. But as we go here, this 200 level, it was accumulated for this entire year before it entered, markup, a little bit of pullback, accumulation, markup, we had crash. And then presumably if we come back down to here, we're going to be accumulated here. We'll see some insane volume or something like that. But we already started seeing insane volume happening in shop. So that's why I just took the first, a couple of you guys know, I took a jab at shop thinking it was gonna, before the CPI numbers, and obviously that trade crashed right there. But I'm stalking shop right now, willing to give it a little bit of risk on options, not just stock. Equity is great if you can afford to, in my opinion, at this level, if you can afford to buy a share every Friday. And I think it's, in my opinion, again, who knows? I'm not much of the fundamentalist type of person. I just like shop. I was a former web developer. It replaced a lot of what guys are doing when building e-commerce websites. So it's just my 2 cents. But as we jump back to the SPY, the phase 1 that's coming, the question is not, retail is saying, when is the bottom coming? The better way, I think, in my opinion, would be, when are we entering phase 1, and where do I want to, what signs do I want to look for to not to really be aggressive with the contrarian trade? It's much harder to do with naked options. You can do all sorts of clever, creative things with spreads. Can you repeat what you just said for the last 2 hours? I don't know if you mean that as a joke or not, but this was recorded, so you'll be able to play it back. And as I said, I will be doing a couple polished videos on this as like the YouTube videos in which I do, where there's a lot of examples and showcasing a lot more. But let me try and come around to the conclusion mark, because we just hit the 2 hour mark here. But keep in mind, does this, can I just get a little confirmation from some of you guys that does this make sense when with the pinning concept as price gets to a certain strike price where your deltas are zero? If you want to, you're going to buy as we go up, and as we come back down, you're going to short. See if I can clarify that, show it on a chart here. If we come up to 400, right? Over 400, you're going to want to buy. But the moment it looks like the market's gets too far past 400, you're going to want to sell because you don't want it to go past 400. That's where all the gamma exposure is and everything. And the market is in a positive gamma state. This is all theoretical. So let's say we're in positive gamma state. If we got back over 400, you can then short the stock as it goes higher, because you're just offsetting your deltas, but you can do it a lot more calm and peacefully. It's not like in a negative gamma environment where you have to just trade in the direction of the trend. Again, I didn't show too many examples of specifically that occurrence. Again, if you really want to dive more deeper into it, you would want to read this, because I'm trying to oversimplify a lot of the contents of this material and hopefully show you guys once this is released, or if you're already using tools that show you gamma, how you can think about this. I just showed you a trade idea using an iron condor. For me, the iron fly on Friday, which was, if I'm thinking the market is going to get pinned around 366, this is another way in which I trade this type of stuff. If might run let's just say I'll go 10 points wide, right? And this was 366. And let's look at on Monday, this butterfly was going for $1.38. On Friday, it closed at 370. There's a nice swing trade, very calm. P&L, no P&L fluctuations really. It went from $1.38 to $1.81. So I didn't really make much money. And then that's how the nature of a butterfly that expires in a week. The last couple of days here ended up returning massive returns here, because it's just eating away. A spread like this is just, you're just trying to get paid on theta. So if I'm looking at this and I'm coming in here and I'm going to evaluate for, where were we for let's look at another ticker. Maybe let's make it a little more interesting. Let's just jump around and we'll conclude with just looking around here. So Tesla, negative gamma. This week's expiration, also negative gamma. Let's take a look at the levels for Tesla for this week. We have 680. So an assumption right off the back, if I'm a scalper, I would tell myself, hey, if we crack over 680, that's the negative gamma 1. So this is the highest negative gamma strike. Okay, we're probably have a nice scalp up to 700. It's just nice 20-point move. But if I'm bullish on Tesla for this week, I might also tell myself, hey, what's a 700 long call butterfly going for? Come right here. Let's go with a long call butterfly. Let's go to Tesla. And let's say, what's our strike again? Close that out. We say, let's go with 680 on the lower end. I might tell myself, okay, 680, 700, and let's go something like this. And I might tell myself, okay, wow, that's amazing, but low probability of success, because yes, this works, but not going to work very often. I might tell myself, okay, maybe I'll go with something like this. It's going to cost a little bit more, but this is a higher probability of actually realizing some sort of gains. And then let's see, and tell myself, okay, let's go with this week if I'm feeling pretty frisky. And by Wednesday, if Tesla does rally, okay, so a grand, that's a really good trade. I might tell myself here, I think I'll take this. And depending on Tesla's price action, how the gamma exposure updates throughout the week, maybe I'll hold it to figure out if I want to see if I hit that home run. But by Friday, I'm probably out of this by Friday morning. But then to play it safer, I usually go a couple weeks out with something like Tesla. Tesla makes me nervous all the time. Even when I was in, I don't know if you guys saw it, the iron fly. I don't post on my iron flies or whatever, because I'm just like you guys. Sometimes I'm just, taking a risk on a trade because I have the slightest inclination or thought that it's going to pan out. But let me see if I can find, actually it doesn't, it's not worth wasting time trying to find the spread. I was in a 650 or 660 iron fly for Tesla, but I went 3 weeks out from 2 weeks prior. So it's a little bit safer. So if we go with something like this, you're not going to make as much money, but the risks you're really going to be, you're not going to be scared at night. Like you'll be able to hold this and say like, okay, again, by Friday, you're going to be up just $100 on 700. So if you get like, 3 of these, so now we're in 3 of these and you're like, okay, here, it's like, there's an easy $300. Again, these are the painless trades. I like to have a few of these running for the week just to sometimes they just cover the cost of commissions from the scalping or just one of these or whatever it ends up being. But if I'm really, really confident, the confidence level just comes with me choosing my expiration. But generally the thought process or the trade idea is more times than not going to be accurate because of the amount of things in which I'm looking at. But to play it safe, the safety just depends on how much the expiration. And if you're looking to be really, really safe, you can go far out and then just get more of them if you're looking to make more money. Because now look at the ranges here for if we were to go to this Friday. Now if Tesla is just kind of hovering around here, it's still kind of green. This is kind of the trades that we tend to trade when I'm trading stuff like the SPX or the one that you guys saw that I saw in the previous week. These trades tend to be really painless. If you're going with an at the money one and you're going with something like this, your break evens for this week, Friday, let's just give this a little bit of a positive delta here. Yeah, like this is and you're in let's say like 5 of these, so like this is still $300, but you're not really taking on much delta risk here. And this is, if you can get a hold over for a couple more days, this is where the returns start really adding up. Now I wouldn't run one like this right now over the weekend, which is why I'm not in one, but I'm just showing you guys for these types of iron flies, something like Tesla, it's pretty fun. And I think I still have a couple of them here. So this is one in which I entered. I close this trade, but then I leave it to let it keep running to see how it would have been playing. But the 3670, knowing where Tesla's max pain was. So the same thing, if we look at Tesla's monthly expiration, which is where they have the most amount of GEX, we go right here. Let's take a look at what things. Let's scroll down here first and foremost. Okay, so we can see Tesla's kind of stuck, and we can see this week, well, Tesla's one of the only tickers that was hovering around max pain this week. There's a ton of gamma here for the monthly expiration, as well as probably the same week, but we're same this week, but we're not going to look at the same week. If we look at this, this is a lot of gamma. Wait, how much is it? 79% of all of Tesla's gamma expires next on the monthlies. Now something could change here, but that's interesting to see. Negative 6.5 million, right? And we come down here, max pain is all the way up here. Tesla will probably have to struggle with the 700 level. If it came down, it's probably going to be the 600 level. If that level breaks, we have what level is this? We have 550. And this is how much if it's obviously below the 0 line, it's negative. And then above this, again, this chart is going to have a lot of other little neat information on here that you'll be able to click and turn off and turn on. And then there's no way Tesla's going to be over 830 again, unless some crazy catalyst comes out. But between here and here, I might tell myself, okay, what's an iron fly going for 600 to 700 for Tesla, and then mark that up and say like, okay, maybe I want to run that swing trade for a bit. Okay, not bad. And say like, I'll be in this for a couple weeks here and be like, okay, and let's get 2 of these, maybe 3, keep it around 3 grand or so. Nothing that I'm gonna want to monitor too much. And then let's pull in and say if Tesla does make it all the way up to 700 by next week, we'll say like Thursday or so, and stuck around 700. Okay, not bad. 450 bucks. Where will I be nervous if it starts getting over 710? I'll come back and take a look and see what let's close this out. And 710, do I need to be concerned with over 710? No, but if it breaks 700, I need to be, it can go up to 720. So maybe if we break 700, I might just get a 720 naked call, or maybe I will just, this is when it would come up. I would have the alert set, so I would, take a look at it or so forth. But this is going to be different ways you guys can use this, and you can expect to see a lot more on this. So as I conclude now, any questions before, let me see if you guys, while you guys have me here to answer. If not, I will see you guys during the week. And I didn't show you guys some of the plays in which I'm in. I don't have the IW1 mocked up here, but just so you guys can see some of my trades here. This is how essentially I'm structuring my trades for the rally. And if I don't really have much risk to theta. So if the market takes all week to consolidate, not really going to be losing any money. If the market sells off pretty aggressively, also not going to lose that much. And SPY, show you guys here. So for this Friday, how I might consider let's go back to the SPY. Let me know if you guys want me to put this out tomorrow, actually, this GEX page. We'll put it out earlier for you guys to play with, even though it's not completed yet. All right, here's the SPY 367. Yeah, we break over 367, we're going to 370. But if the market can hold over 370, you guys can already see it's pretty clear skies above that level, at least for the 0 days. And we were looking at this is Wednesday expiration. Let's jump to Friday. And it's the level to be concerned with, 360. If I go to 360 for Friday, come down here. I believe I only have 2 of these on TOS. So about $300 in risk. And if we get down here, I will probably buy back the short strike and hold the 365 naked, because it will probably bounce back up to 365. And that would be a nice return on the trade, because I would have realized the gains on this short call, and then I would be taking the gains on 365. And if we rally past 365, you can turn a trade like this, where I'm only using $1,900 right here that expires in 26 days. And I might end up pulling out maybe 2K, 3K from a trade like this. And if the market just goes straight up this week and we go all the way up to 380, then that would kind of suck, but I'd make 500 from this one. And I'll just be naked in some calls too for the weeklies. But if it takes an extra week for the market to rally, doesn't really matter to me. Like when it happens, I'm just trying to make sure there's no way I missed the trade. So grabbing a few of these. And if we do make it up to 380 next week, then it's 630 if I don't do anything, if I don't break it up or any sort. There's different ways in which I'll, trade these types of stuff, and the same thing with the Qs. And then I have the same type of trade running in the IWM. It's just I don't want to be exposed to theta. I want to make sure I have a positive delta, and I want to capitalize on, if we go lower, I want to take profit on some short calls, so then I can hold naked, because I'm long the calls that expire 40 days from now. So the theta is not really hurting these calls as much as it's going to hurt these calls. And that's why I love the diagonal call spreads. If you're new a little bit to this type of stuff, you can just run some calendar call spreads, and say, like with the SPY, thinking, okay, we might make it back up to 380, but then if this isn't out the money one, and there you go. If you can run something on the SPX, but I'll stick it to this, keep it to the SPY, and let's just say a couple thousand, and using a term structure like the one I'm using. Let's just say the rally came a little bit here. It's not bad. 44% return here. 60%. The longer it takes to actually, recover, the better it is for you. But you wouldn't want to hold something like this for too long. So maybe around here. And if you're in the SPX, this would be 10 of these, just the equivalent. So just another trade idea. Talking about 2 weeks, you get some of these rolling, you can start pulling in $1,000 a week, when you have a good system, a good flow going. All right, guys. Hopefully I didn't confuse you too much. And
Brian, if possible, yeah, I'd like to, if you can put the update on the website, I'd like to play around with it.
Okay.
If it's possible, yeah.
All right, I'll try to have it probably I'd say tomorrow night. I'll try to have it up, just so you guys, at least what's here. There'll be certain things that are hidden and stuff, because there's a couple other bugs. And but yeah, I'll have it. This works right now, and this works for sure. So there's a couple other things that is hidden from this webinar, but I just want to clean up the UI a little bit to explain. I had it whenever I release stuff, I got to record videos to like explain, like, what does negative mean? What does this mean? Blah, blah, blah. So that's what's going to take a little longer. But for the most part, I guess I can have this up for you guys before market open on Tuesday.
Awesome. Thank you, man.
No problem. All right, guys. Any other questions, comments?
A cool question, Brian.
Mm-hmm. So
would you say for the strategy where you normally, I guess, scout for reversion to the mean, would it work better in a positive gamma environment, or that strategy doesn't really matter?
Yeah, I think it's more likely during a positive gamma, you want to trade reversion to the mean. The example that I used at the beginning of the webinar with the what's on the resource tab, it's just if you know the events happening, like this is the day before FOMC, so you want to be aggressive with your reversion to the mean. But we've been getting, generally after a really large move, we get a lot of reversion to the mean trades here too, because this was starting from the Friday. The market made a really, really big move. And then this was reversion to the mean on Friday. This was the QTA, this was after the big move. That's one trade. Here goes another trade. Here goes another trade. So that's 3 scalps right there. And then if we jump to the Monday, market made another really big move. So what do we get? We get another nice clean reversion to the mean trade. So from here back up to VWAP, like it went a little bit further, but then now we have a ton of supply right here. This is the market holding below VWAP and the QTA zone right here. So we had a sell-off back down to VWAP. If we jump to the following day, which would now be that Tuesday, which was the day before FOMC, great reversion to the mean because the big moves are happening overnight. So reversion to mean, it goes right back up to VWAP, 2-day anchored VWAP, and so forth. This time now we hit 2 sigma, always going to be a nice good trade on that first touch of 2 sigma. Market gapped up the next day, and let's see what happened during the FOMC. We got a nice, this was an amazing swing trade for anyone that took this here, but then we sell off, hit the intraday zone. We sell off, we rally, hit the intraday zone, still just chopping around, reverting to the mean. This is not a day, you know, I mean, we were trading, some of us actively took this trade. It was wild. Like it was a great scalp, but then I gave back a ton of profits because I went long bake right here. And then the market kind of came back and it sucks. So I gave back some profit, but still reversion to the mean nonetheless. And then the following day, same situation here. No, I think, yeah, here we go. Again, reversion to the mean right here. So even though we're in negative gamma environment, these big moves that are happening overnight, the expectancy for it to move again during the day becomes lower. So right here, scalp back up to VWAP. And if we were to then, it wasn't until Friday, we didn't hit any of the intraday zones because at this point it was just complete, like it just stayed at the mean pretty much. It didn't get that low here. So I didn't take this trade on Friday. I was waiting. If we got down here, I would have been uncomfortably large in the 366 calls, but we never got down here. But yes, reversion to the mean, but in a positive GEX, but even in a negative GEX, if a large move happens overnight and it's not a break of a trend. So if like the NEO example that I showed, NEO is a little different because look at the trend it broke. It was a sell-off from earnings. So NEO had earnings here and it just went straight down and then it gapped up on catalyst. This is not a reversion to the mean day. Like it's a break of a massive trend on catalyst, you know, so different story here. But reversion to the means recap in positive GEX after large moves overnight on the SPYs. If it's a stock that made a big move overnight, different story, because chances are a stock only makes a big move overnight, you know, if there was a really big news. But the market, in order for the market to make a really big move overnight, chances are there was a catalyst, you know. All right, guys. Catch you this week and look forward to hearing from you in chat and seeing how you guys start using some of the new features. And lastly, this will be eventually you guys will be able to generate your own watch lists from the GEX and create your own scripts to TOS, which will plot this. But again, the gamma will change throughout the day, but at least you can come up with your game plan and all this will be drawn out on your chart for you, as well as you can choose with which expirations, whatever. I'm going to make it very customizable for you guys to be able to build out this stuff to really your liking and to make it as convenient. But the Discord will always be notified without you having to set the notifications and alerts. And whenever the SPY or Tesla or Qs crosses like an N1 or a P1, N1 or P1 is, that's just my terminology for it. It's just the highest positive one strike and the highest negative gamma strike, which is what's listed right here. So P1, P2, P3, and then the actual calls, if you wanted to know what the call is going for, exactly how much open interest and volume. And as you can see right here, so for example, these puts, they all have almost close to 20,000. And this is for the monthlies, but you can check the current week, and then you can see when the volume starts increasing. Like it's the notifications will come out to the Discord automatically when key things happen. Take care, guys. Enjoy Father's Day for any of you guys out there that are fathers.